You asked for it and I did it. One of the best and biggest price action trading recaps for day traders and scalpers. This video covers one of the best trading view indicator and the best trading strategy I've been using over the last couple of years. We will go through hundreds of trades, starting from the top-down analysis on the technical charts. I'll show you how to enter trades, how to place your stop loss, and how to take profits. Everything you need to go from a beginner to a pro trader. If you are ready, let's go. This month was very tough for day traders overall. Most of the time, there were simply no great setups available to trade. However, even on some days when we did notice great setups, really A++ setups. This was all thanks to our indicator called ICT high time frame candles, which helped us spot interesting points of POI areas and to trade them. By using this indicator, we were able to clearly identify this multi-imbalance point right here on the chart. As a form of support, you can also notice multiple swing failure patterns forming together on the order charts as well. And finally, we can see a very clear target below, which is known as the previous day's low, the PDL. So, what we did here was actually very simple and straightforward. We waited for the price to come back into our multi-imbalance area. Then we looked for supportive structures such as support and resistance flips or swing failure patterns like the one shown in our example. We combined this with clear targets such as the previous day highs or the previous day lows to define our directional bias. This is your high time frame analysis explained in the simplest way possible. After that, the rest is just checking the same point of interest area on the lower time frames like the 15-minute or 5-minute charts or even lower if you want. What we do here is not a rocket science at all. What we do is inside our point of interest area, the POI area, we wait to see if the structure turns to bearish and starts falling to take out the previous day low or something similar. I really hope this is very clear and easy to understand for you. When you open the lower time frames like the 15-minute or the 5-minute charts, the first thing you will usually notice is the area of multi-imbalance and those multi-swing failure points showing up clearly. And if you look below the price, we already know we have the PDL, which is the previous day low sitting right here. And below that, we also have this very clean, almost perfect equal loss, if you've been paying attention. That alone gives us another strong and logical reason for the price come down into this area. When we look at the price action first, you can clearly notice this inner uptrend price movement forming step by step. This structure is very obvious and easy to spot on the chart. And then at some point, that uptrend is clearly broken and no longer holds. That is when sellers start to step in and actively push the price lower. This moment is what gives you the trade opportunity if you are looking for usually with a clean 1.5 hour or even 2 hour setup with tight and compact setup. I can easily say this is an A++ pattern because all the key structures lined up together perfectly in this example. For example, we have multiple imbalance areas stacking up in the same zone. We also have very clear multiple swing failure patterns forming at the highs. On top of that, we have a very clear and obvious target sitting below the price. Then if you drop down to the lower time frames, the inner structure flips into a bearish structure. This aligns perfectly with our directional bias to the downside, targeting the PDL and the equal lows below. Even though I absolutely love this setup and trust it a lot, the main issue is this setup does not happen every single day, unfortunately. In fact, over this recent month, we have only seen a few truly great setups like this one overall. Let's talk about a couple of simple tips and tricks when it comes to multi-imbalance points. As you know, these are very important price action concepts that help define our main points of interest when we are trading. But sometimes price can completely crush these areas and wipe out the imbalances with no reaction at all from the market. This is why I always say that if you are using only a single time frame, you need to be extra careful and be more selective. In general, what we really want to see is a little bit of a struggle and a station in these areas before making any decisions. That could be things like rejection wicks showing up, or even a swing failure pattern forming as a clear concept. To me, this usually means that traders on the opposite side are reacting to this level and considering a possible reversal point. One of the best ways to look at the charts is by opening up the lower time frames in these areas and watching how the price behaves here. You want to see if price keeps making new higher highs, showing that buyers are getting control. Basically, you are looking for an inner upward trend developing so you can eventually join the stronger side of the market. For example, Ethereum had a really great setup recently. I know a lot of you probably took this trade as well. There was a strong price push through these levels, creating this clear multi-imbalance area. As you can see, price pulled back into this multi-imbalance zone, but at the same time it formed a multi-swing failure pattern at the exact same level. So the price was clearly being rejecting from that area. As a clean target below, we had the PDL, which is the previous day's low level. This made it a complete and a very clean example of a high quality trade setup. However, if you look above this area, you will notice multiple bullish imbalances sitting overhead. I think this also looked like a solid area someone might consider taking a long trade here. However, if you look more carefully at this zone, there is no swing failure pattern or any type of rejection wicks. There is also no inner structure break in that area at all. Instead, there's a strong and aggressive price push towards downwards. This tells us that buyers at this level were not able to push the price higher in any meaningful way. These are small tips and details that you really need to look for before entering any kind of trade. Now let's drop back down to the lower time frames and take a look at our short trade idea. So, if you remember with this multi-imbalance and multi-swing failure pattern area, what happens here? Let's break this down for a second. For example, price could have easily continued moving higher and kept its bullish inner structure intact. This is exactly why checking lower time frame structure is sometimes very important. But instead, what happened here is we got a clear inner structure break and price crashed down toward to the PDL, the previous day's low. This ended up being a clean and a solid 2-hour trade opportunity at least here. As you can see, following liquidity, imbalances, and structure changes all together is extremely important when it comes to the trading. Let's keep working on improving our eagle vision by focusing only on the hourly time frame candles to understand the market structure and price action. Once you spot an entry zone with several imbalances and possible support and resistance flips like this one here, what do you do next? The most important supplementary price action you should look for is probably the swing failure patterns, just like the one you see here. These are usually marked by big rejection candles, and if that move is followed by a strong opposite candle breaks, like in this example, we can confidently say the sellers have taken full control of the price in this example. Now the question is, do we really need every single one of these signals to make a trade here? Not necessarily, but it is always better to have multiple confluences working together because that helps us increase our chances of winning in each trade. Let's take a look at this price action setup that shows multiple timeframes from 1 hour all the way up to 4 hours, all in a single layout. You can see the overall SR flip area right here, which happens to sit inside the multi-imbalance level. This kind of setup, the first thing you should be watching for is a swing failure pattern. And if there is a strong breakout that happens right after a swing failure pattern, like the one we are seeing here, that usually means sellers have taken the full control again. At that point, the price is either about to crash or has already started dropping really fast. This is actually a pretty simple pattern to spot once you know what to look for. For example, if you check out the Solana chart, especially if you look at the 2 hours time frame, you can clearly see an SR flip happening with a multi-imbalance level. Right after that, you will notice a swing failure pattern followed by a strong breakdown. That is the exact point where the major crash started. This is another great example of how this pattern plays out when multiple confluences line up in a single time frame. Let's take a look at this interesting chart here. As you can see, there is a multiple imbalance level showing up here, which also happens to be a clear SR flip area. Basically, imbalances and SR flips are the key things that you want to look for when identifying these setups. Now, the tricky part comes when you are trying to spot the swing failure patterns. Sometimes they don't show up clearly on every single time frame. In this case, you should have looked carefully across the other time frames at once to notice the swing failure pattern, followed by a strong break. After that, there was a good drop in the price if you notice a solid move down. Here we have a very clear multi-imbalance level across 4 different time frames, along with a strong SR flip zone. So this is where you got your confirmation or the big call to look for trades. For this setup, spotting the swing failure pattern was a bit challenging. Only the 4-hour chart showed a clear swing failure pattern in this case. Another tricky part was there wasn't a strong break showing directly across multiple time frames, so you had to be patient and wait it out. Like I said before, you don't always need to find all 4 different confluences, all the price action concepts lining up perfect at the same time. That won't happen every single time. But again, more confluences you can find together, the better and stronger your setup will be. Let's take a look at this massive crash, a really intense drop in price. Notice how this crash started. Look closely at this multi-imbalance area that shows a swing failure pattern followed by a strong break in the candles. In this example, there wasn't a super clear support and resistance flip, for example. Like mentioned before, it is not necessary to find all 4 concepts at the same time. You only need at least 2 or solid price action method to build a good trade setup. Now watch how this big crash actually started in this another example. Right here, you can see a multi-imbalance area with a clear support and resistance flip zone this time. A swing failure pattern showed up, then we saw a strong break on the 1-hour chart. And all that led to this huge crash. So, these all patterns combined is basically extremely powerful, helping you catch early entries as much as possible, with multiple price action confirmations to back it up. Yesterday, I got a question about how to identify trends, market structure, and the overall flow and the momentum of the price. So I decided to make a very quick video talking about these exact subjects. Honestly, it's not that hard to see what is actually happening with the price. As a trader, especially if you're a day trader, you always want to follow the momentum and the general price flow instead of trying to catch a reversal. Trying to trade against momentum usually makes things much harder than they need to be. And identifying the current momentum is really not that difficult once you know what to look for. One of the biggest things to focus on is the previous higher time frame high points. If those high points keep getting broken, it is usually means the price flow is moving upwards. And if these major low points are being protected and not getting taken out, that already tells you a lot. At that point, you are starting to see the full story of the market is giving you. So, what exactly is that story telling us? If the price is moving from one point to a higher point, first of all, that shows the strength and power from the buyers. When this is happening and the old highs keep getting broken, it clearly means you have a trend in the place. And if the most of the lows are being protected and the price is not even touching them, this is another strong buyer protection signal. So once you have a clear high time frame flow and a solid trend confirmation, all you really need to do next is focus on the lower time frames. Basically, what you want to do is apply the same exact idea on the lower time frames, like old highs getting broken and the price continuing to make new highs, while price is also moving up on the lower time frame. So this way, you are confirming both the higher and lower time frames and keeping them in harmony with each other. At the end of the day, it doesn't really matter because price is generally either crashing or rallying anyway. If price is rallying, you want to wait for a strong and clear breaks to upside. And if the price is crashing, you would want to wait for a strong and clear breaks to the downside. After that, the next step is simply to follow the exact same process again on the lower time frames. So what you are doing here is combining the higher and lower time frames into the same flow and the same trend and the same overall direction. By doing this, you naturally increase your probability and your overall statistics of taking winning trades. For example, if you look at Bitcoin over the last couple of weeks, what you see here is actually pretty simple. Price was taking a significant loss to the downside, and it was crashing from around 95k down towards the 70 and 60k. So there is a clear price decline happening here. And when I do this, I'm not obsessed with exact lows at all. I'm simply looking at whether the major lows on this chart are getting taken out or not. While all of this happening, if you look at the high points, you can see that generally they are being protected. Now here is my question, and it's a very simple one. Who has a better chance of winning right now on this chart? The short traders or the long traders? Which side clearly has the better odds and probability at this moment? I think the answer is pretty obvious here. If the price is crashing, making new lower lows while the highs are still being protected, it makes much more sense to look for a short trades instead of long trades. This is not an opinion at all, it is simply based on statistics and probability in the data. So when you drop down to the lower time frames, you follow the exact same idea here. You wait for the lower time structure to shift downward as well. To avoid fake moves and false signals, you may want to wait for a couple of breaks to the downside instead of a single break. Ideally, you want to see 2 or 3 clear breaks of the structure moving downwards. By doing this, you are confirming 2 important things here. You are confirming that the high time frame and the low time frame structures are both strong and moving together. When the flow is aligned and moving in sync in the same direction, this will dramatically increase your chances of winning trades. Let's work on improving our skills at spotting entries, targets, and stops all together at the same time. As you already know, some of the very best entry points come from the multi-imbalance zones combined with multi-swing failure patterns, especially when we use those mid-time frames. And when you combine that SR Philip line, it makes the whole setup even stronger and more reliable. Let's first talk a bit about the targets. One of the most common types of targets are institutional levels like PDL, which stands for the previous day low. When that level lines up with equal lows, it gives us a super clean and obvious target to aim for. Now let's switch over to entries. Right here we've got a really solid entry zone that's built around a mix of multiple imbalances and SFP, or swing failure pattern. And if you look closely, when there is an inner liquidity sweep, like the one we are pointing out here, it gives you an extra layer of confirmation and confidence. The rest is not too complicated actually. It all comes back to structure. So, what we are doing here is putting together three main elements: liquidity, imbalance, and structure, all working side by side. Now let's take a look at this chart and talk through the price action and trading details. Finding these entry zones is really not that hard. For example, if you look at this Bitcoin chart, you will clearly see multi-imbalance area forming. And if you shift your eyes over to the far right, using the early chart data, you can actually spot two very clear swing failure patterns. So, what do we have in this entry zone? We've got 6 different imbalance steps, plus 2 swing failure patterns. On top of that, there's also a really clean target sitting below PDL, the previous day low, lined up with equal lows. Altogether, that makes this an A+++ high quality setup. Alright, let me switch over to the lower time frame so we can break this down even further. This is great right now. You find your entry zone using multi-imbalances and several swing failure patterns. You have a clear entry zone to work with. Now, what about the target here? Do you have a target? Let's talk about that. First of all, notice this perfect equal lows. This is not an ordinary equal low. It looks like almost hand-drawn. And it's actually combined with the PDL, the previous day low, as a target. It is funny that the price came here almost taking out the PDL, but it did not. Then it created the most perfect equal lows you can ever see in any chart. You can also see that this happens at a proper SR Philip area, a price level that rejected multiple times. Also on this 15-minute chart, you can notice a large imbalance area as well. Okay, all of this great, but how do we enter this trade? Let's talk about that. So on this 5-minute chart, what do we know? We know we have an extremely clear target below and a great entry zone with 6 imbalances and 2 swing failure patterns came together. So all we need right now is a great structure. So as you can see, there is a market structure break here, then pulls back into an imbalance and then crash to take the PDL out. I think this is one of the clearest setups you can take, and I saw many students on Twitter took this trade. In simple terms, what happens here is actually not complicated. This is PO3, the power of 3. Large accumulation occurs, manipulation happens at our entry zone, finally expansion pushes the price to take out the target. It is actually that clear and simple. The next day, the exact same setup happened again. This time, let me walk through everything in reverse, like reverse engineering the move. First, if you look closely, price took the PDL down below the previous day low. But how did it happen? Check carefully. The market structure breaks because the inner trend flipped and became a clear downtrend here. So structure changed to take out the PDL. But the question is, why did this happen in this specific area? Why is this area so extremely important? First of all, notice the inner SR flip right here. Then you can see the inner liquidity sweep, the equal lows being hunted, and all of this happens inside a large imbalance area. So this becomes the maximum fuel point. There you have the SR flip, the inner liquidity sweep, and the large imbalance all together. However, remember that is just the low time frame analysis. What matters the most is what happened on the higher time frames. Let's take a look at the top to see the higher time frame action. First of all, you can clearly see price was crashing badly on the higher time frames, and the downtrend is obvious. Right at this point, you can notice the 5 imbalance taps in total. And this is combined with 4 swing failure patterns sitting right inside those imbalances. And like we already said, who is dominant here? It is obvious the sellers are in control. Look at the gigantic red candles, each one making a strong break downward. So altogether here we use liquidity, imbalance, and the structure. We combined these 3 elements to take this trade. I heard that some of you having trouble trading ongoing rallies, whether it is in cryptocurrencies, gold, silver, or the Nasdaq, or any other asset classes out there. First of all, what does a rally really mean? Understanding the structure of a rally is actually not that hard once you break it down in simpler terms. What you usually see is multiple green candles printing consistently, with price pushing higher and higher over time. And most of the time, we notice this clearly on the hourly charts, like the 1 hour, 2 hour, 3 hour, or 4 hour time frames. So what you should be checking is whether the price keeps taking out previous highs and making new higher highs on those hourly charts. That kind of price action clearly shows the strength coming from buyers in the market. But that alone is not enough to confirm good and healthy rally. Second, you also need to check the low points of the candles and see if they are mostly being protected or not. If the lows are holding and not breaking down, that tells you that sellers are not strong enough to create multiple lower lows to push the price down. So overall, what you are looking here for is a strong increase in price within a short period of time. I am talking about an asset that can move 10, 20, or even 30% in a single day. For example, if you look at this specific cryptocurrency, after a period of price accumulation, it did break out and rally significantly started in a single day. Then you will notice that alt highs keep getting taken out by buyers as the price continues to pushing up. At the same time, the alt lows are mostly protected, so sellers unable to push the price back down. And overall price moved from $150 to $200 just in a single day, which is about a 30% gain. This is where most people make a big mistake. They try to focus on exactly where and when the rally starts. And believe me, it is extremely hard to consistently catch the exact beginning of a rally in any asset classes. So do not focus all your energy on trying to predict when the rally is going to start. Instead, focus on the rally that is already in progress. An ongoing rally is much easier to recognize, and it is much easier to trade with confidence. Now, let's drop down to the 5-minute or 15-minute charts from the hourly charts and really think through what we should be doing here. Remember, you are not trying to guess exactly where the rally is going to start from the very bottom. Instead, you are simply trying to join an ongoing rally as a trader and write the move that is already happening in real time. Your first step should be pointing out the significant high points on the 5 minutes or 15-minute charts. Just mark them clearly as they happen and keep your focus on those levels. Once those highs get broken, you need to ask yourself one simple question. Is there a pullback happening after any significant breaks? And remember, not every single breakout will give you a clean pullback to enter. For example, right here there is no pullback at all. Price just keeps rallying straight up without giving any real enter opportunity. But if you look at a little higher on the chart, there is a clear significant pullback that gives you a chance to enter. And if you are looking at our rally on the real charts, you will notice that one of the recent high was broken very strongly. And there was no pullback at all to give you a safe or clean entry here. However, if you just focus on the prior high point instead, once that level is broken, you can see a strong pullback area forming. Inside that pullback, there are inner imbalances that give you a solid place to enter a trade. So trading rally is really just about joining the ongoing move and the strength behind it. You are simply trading with the momentum and going with the overall trend here. It has been clearly proven over time that trading with the force and the trend is much easier, and it usually gives you a much higher win rate compared to trying to trade against the momentum. Today, let's talk about how we can tell when the market conditions are changing and how we can adjust to them in a smarter way. As you know, price always gravitates toward liquidity, especially institutional liquidity that it wants to sweep, like the previous week's high or day's high. So when you see clear targets and strong bullish structures like multiple imbalances, demand order blocks, or support to resistance flips, you start forming your trade ideas. You are looking to take a clean, compact, long trade right here, and it is the right idea. And if you are in a hurry, you might even place a limit order just like this one. And honestly, this setup is a valid and solid, and there's nothing wrong with taking this trade. But somehow you still get stopped out. The setup just doesn't play out. And that's when you need to pause and ask yourself a few questions. Is the structures failing or not? Do we have a new direction forming and maybe a closer target here? Where is the nearest liquidity that might actually matter right now? Because in this example, you will notice these bullish structures aren't holding up really well, and they are getting broken. And this is the moment where we need to accept that the direction has shifted. Price is now hunting a completely different pocket of liquidity. So when you start seeing multiple bearish imbalance zones forming, along with the failed bullish structures, you can flip your idea and look for trades in the opposite direction. And there's absolutely nothing wrong with doing that. Actually, this is what happened with Bitcoin this week. Price had these weekly and daily high liquidity levels sitting above, and we also had last week's low sitting below. But I was mostly focused on those upper targets and kept thinking about taking a long trade. We had a bunch of strong bullish structures forming. First of all, this inner liquidity got swept. Price then pulled down into this multi-imbalance area where that deep order block was sitting. So if you placed a limit order somewhere around that zone and just left the charts alone to go to do something else, it honestly wouldn't have been a bad idea at all. In my opinion, this was actually a really solid setup. But sometimes the quality of your setups doesn't matter at all because the market can crash out of nowhere suddenly. If you look closely here, what happened is that price changed direction for much closer target now, which was the last week's low acting as the main liquidity for us. And our multi-imbalance area with that demand order block completely failed to hold the bullish movements. After that, the rest of the price action was basically just simple multi-imbalances move aiming to take out the previous week's low. So the whole point of today's lesson is that when bullish or bearish structure starts to fail, it usually means we are shifting our bias and the market is heading towards a new pool of liquidity. Let's talk about multi-imbalance areas and how to look for possible trades inside these areas. What we do here is actually not that overly complicated, but the problem is that things do not always happen the way I want them to happen. For example, ideally, seeing an SR Philip area along with the special structure movements inside these imbalance areas would be great to see. So, for the example, price making higher highs during an internal pullback, which I like to call an inner upper trend, is what we want to see first as a pullback. Then what I would like to see the next is clear shift in the structure. So the uptrend turns back into a downtrend again, following the general price action. And after that, price crashes toward an ideal targets like the previous day's low or the week's low. So what you see here is the ideal and the most optimal price action that we want to see. But unfortunately, this does not happen every single day. For example, Bitcoin had this pretty incredible crash recently, dropping from 95k down to the 91k roughly in 2 hours. Now, honestly, I do not enjoy crashes like that because this is not really a clean price action in my view. This kind of move is basically news-based, a global reaction crash instead of something driven by natural price action. However, if I really wanted to trade this move, I would much rather to see price slowly pull back in an upper uptrend into this support and resistance Philip area, for example. That type of move would be my ideal setup and what I would expect from healthier and more controlled, nice, clean price action. The reason is because the news-based gigantic multi-imbalance areas are extremely hard to manage. We also do not really know what might actually happen inside this zone once price is moving through them. However, if you still focus on the price action and structure itself, especially for example in this case 1 hour chart, you can see the move shifting downward to take out the PDL below. So, what you are seeing here is a clearer price movement with an inner structure trend change moving toward a clear target. However, I have to be honest here. These multi-big imbalance areas caused by news are not healthy at all and are not great price action to trade with. If you go down to the lower time frames like the 15-minute or 5-minute charts, you can see the inner structure much more clearly. After a big news drop, price usually starts to pull back with an uptrend first, creating small, higher highs along the way. That inner uptrend then breaks and turns back into a downtrend again to hunt the PDL, which is the previous day's low below in this example. So in this case, the trade does work out. But the real problem with this news-related price action is the uncertainty. We honestly do not know how far the price can pull back or how many times that inner trend might change direction. No matter what approach you take, you still need to combine liquidity, imbalances, and the structure together. Those three elements working together are always what give you the best possible results in trading. Recently, I got a question about order blocks, so I decided to make a quick and simple video explaining how to identify clean order blocks and how to trade them right away. Order blocks by nature are not very complicated once you really break them down and understand the basic idea. So it's basically the opposite color of consecutive candles in a row that appear right before major breaks in structure or strong trend reversals. For example, during an upward rally, the last two red candles before the strong move up can define a demand order block here. On the other hand, before a major crash with an internal break of structure, the last two green candles can define a supply order block. Now, if you really want to make order blocks more effective and more reliable, it is best to combine them with imbalances. So when you look at this price action, right here, what we are seeing is a combination of order blocks, imbalances, and structural breaks all working together. When all these elements line up at the same time, they create a very powerful setup that many traders call dragon fruit combination. Especially when you look at earlier parts of the chart across any assets, you will notice there are many order blocks forming all over the place. Naturally, this concept does not work every single time, and it is important to understand that. However, when it does work, it usually leads to strong and aggressive price movements. If you look at this chart right here, you can clearly see a clean supply order block in this area. It is also combined with a large imbalance zone that formed right after a structural break. Notice how the crash actually started from the exact order block area. And if you shift your focus to the right side of the chart, you can see a strong move up that came after the combination of imbalance, break, and the demand order block this time. That combination is what started the massive rally and pushed the price sharply higher. However, if everything were really that easy, then everyone would be making money in the markets. And of course, that's not the case at all. There's absolutely nothing easy about trading, I assure you that, especially when the real money is on the line. First of all, you will probably notice that half of the order blocks get completely destroyed without any reaction from the price. In many situations, price simply comes into the zone and keeps crashing straight through, and the demand area never holds at all. And that is exactly why it's so important to pay close attention to the lower time frames. Basically, when you identify an hourly order blocks like 1, 2, 3 hour order blocks, you also need to check the minute-based inner structure before making any decisions. If the inner structure trend actually shifts inside your demand area or supply area around that order block zone, that is when things start to look more interesting. For example, let's take a look at this crash area with the supply order block combined with an imbalance and the inner break. Like I said, there's no guaranteed rule out there that says supply and demand order blocks will always hold. As you can see, price in this case could easily rally higher to take out offers without any hesitation. We simply do not know in advance what price is going to do next. It is impossible. But if you carefully and study inner structure, you can see the market structure shift followed by internal break of structures here. So in this situation, the higher time frames and the lower time frames are now aligned together. So what does all this really mean for you as a trader? Basically, when you identify hourly order blocks, whether it is on the 1, 2, 3, or 4 hour charts, it does not matter if they are supply or demand blocks. You then need to drop down to the lower time frames, especially minute-based charts, and check what is happening at your entry location. You want to see if the inner structure is actually changing and whether the supply or demand area is truly holding or just failing. When you combine these two different time frames together in a smarter way, you give yourself a much better chance of getting stronger and better results in your overall trading journey. Let's talk about liquidity. This is one of the most common questions I get asked all the time. By now, you probably learned how to identify important liquidity levels, things like hourly candle highs or lows, maybe the daily, weekly, or monthly highs or lows. You also seen setups like equal lows or relative highs or lows. Now, the next big question we should ask is, let's say that significant liquidity level is hunted. What happens next? What should we be paying attention to? And what kind of price action should we be watching for? Once a major liquidity level is taken out, the first thing you should do is just wait a bit. Take a step back and watch the price and really observe what is really going on here. See how the market reacts right after the liquidity hunt. Usually, there are two possible outcomes. Either the move continues in the same direction or it reverses. For example, if the price struggles to push back up and can't make any meaningful break of structures, what we call a market structure break, that liquidity level often turns into a new support and resistance flip zone, and the move just keeps going on in the same direction. On the flip side, if the price jumps back in and starts break off structures or creating new market structure breaks, that's usually a sign of a reversal forming. And this is exactly why it's so important to wait a little bit after a liquidity hunt before jumping in. We need that extra time to see what the market really wants to do. Because honestly, no one in the world can know for sure what will happen right after a liquidity hunt. Now let's take a look at this Ethereum chart. Ethereum had a really significant liquidity level here. We are talking about 4-hour candle low level, also the previous week's low level, and there is relatively significant equal lows around this area. So overall, we had a bunch of liquidity levels lining up, and the price hunted this zone with a really strong and fast move. Now the question is, what usually happens after a liquidity hunt like this? If you look closely, the market structure breaks on this lower time frame. Then the price makes a little pullback into this inner BPR area. After that, it runs back up toward this inner equal highs level above, which becomes our clear target. If you zoom in on this area, you can actually see the price action very clearly. It is not complicated at all. In fact, this is one of the core setups combining smart money concepts and basic price action. That is why it's important to watch how the price behaves after major liquidity hunts. You want to see whether it keeps following the existing trend or starts breaking structure and signaling a possible reversal. Let's talk about how you can improve your trading game in a smart and practical way. I want to focus on finding trades in a very specific zones where price is more likely to react. As you already know, support and resistance flip areas are one of the core trading methods out there, and they are used by millions of traders around the world. So basically what happens here is that a strong alt support area that has been holding the price for a while suddenly gets broken. Then the price starts to move back up toward that alt support area. And what we expect at that point is for that alt support to act as a new resistance. This is usually where we step in and play our game around these multi-imbalance trading locations. Now here is an interesting question to think about it. During the pullback, if the inner structure is bullish while price is moving towards the support and resistance flip location, can we take small scalp longs? And yes, the answer is absolutely yes. What we are doing in this situation is trading a counter trend, basically looking for a small reversal using the inner bullish structure. Is it riskier than usual? Yes, it is, because you are trading against the main higher time frame here. But it can still be usable sometimes, especially if you don't see any other clean setup in the market. However, the main trade idea still sits around the support and resistance Philip line. But we really want to see a strong rejection candles forming around the SR Philip and the multi-imbalance area. And more importantly, that rejection should be followed by a clear structural change. That means the inner trend should be also shift from uptrend into a downtrend. But most of the time, that first market structure break can be tricky. There can be a lot of fake moves and false breaks in the beginning area. So if you want to more secure and higher quality trades, it can be smart to wait one or two more structure breaks forming the clear downtrend here. As you can see, what you are really doing here is playing the both sides of the game. You take the riskier longs during the pullback, and then you focus on better, higher quality shorts once everything lines up. Now let's take a look at a couple of real examples directly on the charts. What you're looking at right now is the hourly chart. The hourly chart is a great starting point to understand the current price action and the overall direction of the market. Notice how the recent price created this extremely large imbalance location, then pushed back into it, and after that it completely crashed down. As you can see, this move happened right inside a significant support and resistance Philip location. It was a strong old support level that later turned into a resistance area. And right here at that level, you can clearly see a nice swing failure pattern forming. So everything is lining up together here, including multi-imbalances, multi-swing failures, and SR Philip location on the higher time frame. Now I'm going to drop down to the 5-minute time frame to see what is happening inside the inner structure, the low time frame structure. First of all, you can see that at some point there was a bullish run that got created. We had the first market structure break, followed by another break of structure moving towards the multi-imbalance and SR Philip location. However, the moment price tapped into our higher time frame concepts, the inner trend shifted once again. We then created a bearish market structure break, which clearly shows that the sellers are stepping in and taking the control back. And here is the important tip that you need to remember. If you struggle with using market structure breaks, then simply wait. Wait for the next clear break of structures to form. Let the downtrend become more obvious and more structured before you make a trading decision. And then, as the price starts dropping aggressively, you can use different methods to enter a short position here. For example, you can use inner imbalances or maybe build small average cost entries in the area to help to push the trade further to downside, especially using my yo-yo style dollar cost averaging methods. In this episode, we are going to dive into a student's trade and really break down what he did and how he took the trade from start to finish. Along the way, I'll also talk about our indicator with multiple time frames and explain how to actually use it in a simple, practical way. As you already know, multi-imbalanced areas are great places to look for trades, especially when you're trying to plan ahead. More importantly, what happens inside these areas is extremely important and can tell us a lot about price behavior. One of the first of strong tradable areas is seeing swing failure patterns, especially when they are combined with support and resistance flip points. This gives me confidence that a possible reversal can happen in this area instead of price just continuing in the same direction. So what we expect to see here is a structure shift followed by a price moving toward a clear target, possibly. Targets like major liquidity points such as equal lows, equal highs, or the previous day's low or highs can be great open liquidity targets for us. So what we really need is strong and meaningful liquidity areas that are capable of pulling the price towards them. And in the end, what we want to see is a structure shift and a clean trade opportunity like one shown here. As you can see, this is a complete price action setup that can be used in almost any kind of market situations. Now let's get back to the student trade. First of all, by using this ICT high time frame candles indicator, we can identify and analyze multiple time frames at the same time. This allows us to see different types of price action and smart money concepts together without constantly switching between time frames. For example, when you look at the 1 and 2-hour time frames, you can clearly see the multi-imbalance area, followed by a multiple swing failure patterns and multiple SR flips at once. Because of that, you immediately get a clear trade idea along with an expected move that could happen. The next thing you should ask yourself is whether there is a real reason for the price to crash downwards, a possible target maybe. Now, when I open the 5-minute time frame, things actually become much clearer. This is where the multiple smart money concepts and price action methods really come together. This is the exact area that we identify using our indicator. When you look below, you will notice some very interesting targets. First, we have the PDL, which is the previous day's low area. On top of that, it is actually combined with equal lows that formed later on. So now we have a logical and clear reason for the price to crash down into this area. After that, the rest is simply a structure shift and taking an entry. This is really a strong setup, probably one of the A++ setup that you can come across. I want to congratulate all the students who were able to take this trade. Great work, guys. Let's talk about how to read the markets using only hourly candles and how to understand the price action from those high time frame candles in a deeper way. You already know how to spot POI areas, points of interest, by looking at multiple imbalances, swing failure patterns, or some support resistance flip zones. This is the easy part. Now, what we need is that eagle vision, the ability to read the price action clearly just from higher time frame candles. So let's say the price drops into your POI area like this, with huge red candles forming one after another, showing massive downward pressure. That usually means sellers are completely in control here, and the buyers are too weak to push back. This is a clear sign of a strong downtrend at the moment. And if you also notice large bearish imbalances forming in that same area, that's another clue that we are still in a solid downtrend. Buyers aren't responding at all. They can't even fight back against the seller pressure. Now, the first sign that sellers are losing strength comes when you start seeing those big rejection candles with large wicks. Some traders call them hammers, others call them pin bars, but in price action we refer to them as swing failure patterns, SFP. That basically means buyers are starting to step in. They're reacting to the selling pressure and giving their first pushback. Then when you start noticing strong green candles breaking upwards, it is a signal that sellers are finally weakening and buyers are trying to regain the control back. If the price keeps breaking new highs candles after one another, this is a good confirmation that buyers are now taking the control and new uptrend is beginning. However, sometimes you will see a double swing failure pattern or two pin bars or two hammers appearing on opposite sides. That usually means there's a big conflict happening in that zone. Buyers and sellers are both fighting hard for the control, and it might take a while before the market decides who wins that battle. For example, let's take a look at this chart on one of the hourly time frames. If you notice, we've got a really strong imbalance area that connects perfectly with a clean support and resistance flip zone. However, if you pay attention to the most recent price action, you will see that the price is crashing hard with massive red candles. It keeps breaking structure one after another, showing no signs of seller weakness yet. Buyers simply can't step in or respond at the moment. Now, if you drop down to the lower time frames, like minute-based time frames, you can clearly see the price action here too. The bears are creating new breakout structure moves one after another. It is a clear downtrend, and there is no sign of buyer response yet. Let's have a look at this example. Again, we have a clear POI area in the middle and a big crash into our entry zone. Then a swing failure pattern forms, followed by huge green candles breaking the structure by taking the highs. That's the moment sellers start to lose control fully and buyers take over. It is a clear sign of a strong buyer momentum. And when you zoom in even further to lower time frames like 5-minute chart for example, the price action becomes crystal clear. Right at our POI area, the market structure flips, and then multiple breakout structures following, pushing the price higher and higher, starting a solid uptrend in the lower time frames. Now, in this example, things get a bit tricky. You've got both strong bullish and bearish imbalances happening at the same time. And both sides have swing failure patterns as well. This is the clash of titans, buyers and sellers, the big fight, the big war. If you focus on this area, you will notice that for about 6 hours, the price stays stuck in the range, caught between this battle of buyers and sellers. The outcome of this kind of fight is usually uncertain. Either side could win. It is completely out of our control. We just don't have enough data to know who will take control yet. So in this video, you've learned how to read price action by only focusing and using the high time frames. I was getting a lot of questions about liquidity and how to really understand it and actually master it in trading. So I decided to make a video that is 100% focused on the liquidity and nothing else. First of all, in my opinion, finding and understanding liquidity areas depends heavily on the current trend and the overall momentum. As you know, I'm a big fan of following the general trend and when it comes to trading in the markets. The first thing you should always want to look for is price taking out the prior old highs or not, because this is a big sign of strength, clear trend direction, and real power in the markets. Naturally, traders like all of us want to follow the trend and keep entering trades with the same momentum. However, as more traders enter, the number of positions keep increasing. This creates a lot of open stop losses in the market. Over time, you will start to notice a pool of stop losses building up around certain specific price levels. This is a moment when liquidity pools are created in the market. These areas usually consist of thousands of stop losses sitting in the same zone from traders all around the world. At some point, those stop losses are usually swept, and then the general trend continues to flow in the main direction again. It does not matter whether the market is rallying or crashing. The core idea stays the same in every market condition. As traders, we like to follow momentum and trade in the direction of the overall trend. This is because statistically, following the trend tends to make more money than trying to trade against it. But that does not mean we can enter trades at just any random point. We need to be aware of liquidity pools where thousands of stop losses are stacked and gathering in specific areas. We also need to understand that liquidity pools can be created and swept at any moment. As I said before, following the prior highs and lows and knowing which side is getting taken out is critical for understanding the trends. The problem is that no trend or momentum lasts in the same direction forever. At some point, even if you see a liquidity pool get swept, it does not automatically mean the trend will continue. After that, you may start to notice internal breaks forming in the opposite direction after or with a major break. So this can often be the point where the trend reversal begins. So let's look at this example. On this chart, you can see a big major break that was taken out earlier. Many traders want to follow the direction of new upward move, which is a very natural reaction. However, all of these newly opened trades, sometimes thousands of them from all over the world, creates a heavy concentration of stop-loss orders in the similar price levels as you can see. In many cases, this behavior is followed by a large and deep liquidity sweeps. After that, the price action often shows internal breaks again, leading to a second, third, or even fourth of the main rally. So as you can see, understanding liquidity and where it gathers is extremely important. Using this information in the direction of the trend can be a strong and effective strategy for most traders out there. Today, let's think about point of interest areas and why they actually matter in trading. In reality, everybody has a different kind of point of interest or POI area they focus on. They might use indicators, simple price action, or even smart money concepts to define those areas. So overall, you will always have some kind of idea about where your point of interest is on the chart. Now, the most important question is this. When the price comes into your point of interest area, what should we actually do next? For example, imagine this POI area is for a bearish setup and I'm looking to take a short trade here. If you look closely, once the price comes into my zone or pocket, I could technically take a blind short right here. This is definitely possible and sometimes I personally do that in certain situations. However, this is a low probability trade and it requires a reduced risk management. The reason is simple, you do not have any lower time frame confirmation in this moment. So a better approach is usually to use lower time frame structure and trend for confirmation. For example, inside the POI area, if I see price keep making new lower lows and then start to break down aggressively, that tells me that sellers are taking the control now. The selling pressure shows a real seller power. And now I can look for short trades with much higher confirmation. In this case, we can call it a confirmed short instead of a blind short. You can absolutely use both trade ideas in your trading plan if you want, but you cannot assume these are the same type of trades. One of them clearly has a lower probability, and the other one has a much higher probability of success. If you were watching the Ethereum chart recently, you probably noticed a pretty clear and important pattern forming on the hourly charts. What was happening was one of my favorite patterns to trade, where the price was overall stuck in a strong crushing downtrend. During this downtrend, price kept pushing back into these imbalance areas and also tapping into previous support and resistance Philip levels. In both of these situations, you can clearly see how they create really solid short selling opportunities. So, when I saw this last setup with that imbalance and the support and resistance Philip point, I immediately started thinking about another crash coming. And if you carefully look at the chart, you can see that clean crash actually did not happen at all. Instead, with that last pattern, even though I fully expected a crash, the setup failed really badly. It completely broke down and basically destroyed my trade idea. This is exactly why it's so important to check the lower time structure and the overall trend before taking a trade. Now let's drop down to the 5-minute chart and talk about this little more. When I was looking at this last setup, I also noticed the previous day's low level sitting right below the price. That detail alone actually gave me even more confidence to consider taking a short at this trade. This was because it was a very logical and expected price movement based on where we were on the chart. But if you carefully look at the inner structure, there was this very clear and undeniable uptrend moving upward, and upward, consistently pushing the price higher. So the lower time frame was not aligning with my higher time frame idea at that moment, which was a red flag for me. In my point of interest area, I should have seen something very different happening. I should have seen a bearish trend or a bearish structure clearly forming and moving toward the previous day's low area. For example, I would have wanted to see a clear and strong microstructure break followed by a couple of break of structure moves starting directly from my point of interest area, the POI area. This could have been a great trade in my opinion, but unfortunately that confirmation never happened. So, like I always say, combining liquidity, imbalances, and structure together all at the same time will give you the best and highest probability setups in your trading journey. Today we are going to focus on a step-by-step 10-year strategy. I will walk you through every single step in the simplest way possible. So let's get started. Now, the very first step is identifying tradable areas. For this, you will need to check multiple higher time frames such as 30 to 45 minutes and then 1, 2, 3 hours or even 4 hours. What you are doing here is actually very straightforward. You are simply looking for a multi-imbalance area. Inside these areas, you then try to find multiple swing failure patterns. Now, swing failure patterns are not absolutely mandatory, but they are very strong supportive structures. Alright, you just completed the first step. It is extremely simple as you can clearly see. So what comes next? In the second step, you will move down into the lower time frames inside this tradable zone. Here you'll be searching for an extra supportive structures and possible trade entries. When it comes to your lower time frames, I suggest you focusing on 15 minutes or below. That could be 10 minutes, 5 minutes, 3 or 1 minute. It doesn't matter. Remember, this is the same area that we identified back in the step 1. The zone with multi-imbalances and swing failure patterns. Now, for your next step, it is really beneficial to look for a support and resistance flip zone, or even what I like to call a masterclass amplifier like the previous day's high or week's high. These are natural support and resistance flip levels, and it makes your trade setups much stronger. Perfect! You have now completed both step 1 and step 2. Now we move on to the step 3. In the step 3, we are going to look for clear targets. So what are clear targets? They could be the previous day's high, previous week's high, or similar institutional levels. They could also be equal highs or equal lows, maybe even relative highs or relative lows, and possibly even empty imbalance areas combined with those levels. So to repeat, step 3 is all about looking for clear targets. We need clear targets because we always want a reason for the price movement. Why should the price move up? Why should the price move down? Usually, it is because the price heading to hunt specific levels or liquidity. That's why having clear targets is so important. And there you have it. Step 1, you find yourself a tradable area. Step 2, you confirmed it with extra supportive structures. Step 3, you identify the great and clear targets. Now let's move on and talk about the trade entries. So the entries will be our last step. This is the step 4. We are still working on the lower time frames, and now we are looking for a clean entry points. The most simple and easy way to find an entry is by spotting a microstructure break. That means watching for a shift in the trend, waiting for a small pullback into an imbalance area, and you are taking the trade. These should be small and compact trades, usually maximum of 2 are at a time. This is the most straightforward version of the strategy. But here is the thing. Reversals after a deep pullbacks are always tricky. They can stop you out many times, and that's where a lot of traders get frustrated. This is why I sometimes suggest waiting for the first break of structure if you find yourself stop out too much. Maybe you notice an inner support or resistance flip in the location, paired with an inner liquidity sweep and even an inner imbalance area forming. These setups are what I call the A+++ trades. Why are they so powerful? Because when you see that first break of structure right after the market structure break, it gives you stronger confirmation of a true trend change or a real reversal. At this point, you already have at least 2 highs and 2 protected lows on the chart. And when you combine that with something like an inner support or resistance flip in a liquidity sweep with clean imbalances, the trade becomes extremely powerful. But still, the goal is always taking small and compact trades. Keep it to maximum of 2 trades. Now let's walk through a full example together, step by step. Okay, here is our step 1. We will be looking for multi-imbalances and multi-swing failure patterns in this Bitcoin chart. Now notice this area carefully. We can see 3 imbalances combined with 2 swing failure patterns. This is a very strong sign of a tradable area, a zone where we can confidently look for more trading opportunities. And just like that, you have completed the step 1. Now moving to the step 2. Here we want to look for an SR flip, or maybe what I like to call a masterclass amplifier location. As you can see, there is a very clear and significant SR flip right here. Price has rejected this exact zone, the price level, at least 4 different times before, which makes it a very important location. And that's it. You have now completed the step 2 and step 1 together. Next, let's go into the step 3. This time we are looking for a clear and obvious targets. In this particular trade, we actually have 2 distinct targets. The first one is the PDH, the previous day's high, which is considered an institutional level. If you look closely, it is also combined with a set of relative equal highs. So we now have a clear target above us and strong reasons for the price push higher. Now you have completed the step 3. Let's zoom in on the area and talk about possible entry setups. Right in the center of this trade zone, you will notice the market structure break. After that, price pulls back directly into an imbalance zone, This immediately gives us our first 2-hour setup, which is a solid and a very acceptable trading idea. As you can see, this 2-hour setup is extremely compact and very tight. Then right after that, we get the very first break of structure. It is supported by a small inner SR flip, an inner liquidity sweep, and another inner imbalance. Together, this creates another clean 2-hour compact setup. Now, like I mentioned before, those first reversal points that market structure breaks can sometimes be tricky. If you find yourself getting stopped out several times, it is better to simply wait for the first break of structure after the market structure break. This way, you are trading with a stronger confirmations of the trend after a reversal point. And by looking for inner SR flips, small liquidity sweeps, and other imbalance zones, you make these inner trades much stronger and more reliable. And that's it. This is one of these A+++ trading setups. I do not think there are better setups you can ever find out beyond this all over the internet. Today, let's talk about when to look for shorts and when to look for longs and how to decide what to do when we are staring at the chart in real time. As you already know, price likes to move towards specific levels on the chart. This can be things like the institutional liquidity, the previous day's high, or maybe equal highs or lows that act as clear liquidity levels. But just knowing those levels exist is not enough to actually take a trade. You should always look at the inner structure of the market to understand the current direction and momentum. For example, in this chart, at a certain point, the inner structure is clearly bullish and pushing towards the previous day's high point. The next question you should ask yourself is simple. Should you be looking to short this move? Or should you be looking to long this move? The logical answer is to always follow the inner structure and trade in the direction it is showing you. So in this case, taking a long position makes the most sense because the structure is bullish. But what happens once price reaches and hunts that institutional level? What should we be thinking about that point? We still need to look for additional clues from the price action before making another decision. For example, is the price getting rejected from that level? Maybe forming something like a swing failure pattern. Another important thing to check is whether the structure has changed and the inner trend has now turned bearish. If the momentum shifts and the inner structure flips to bearish, then taking a short and following that new momentum becomes the better idea now. So basically, this is how you read the clues the market is giving you and use them to guide your trading decisions. Let's take a look at this specific example at Bitcoin that happened just a couple of days ago. What you will notice here is that we have the previous day's high, combined with equal highs sitting above it, and a very clear price action. If you look at the internal structure, it keeps making new higher highs in the same direction. So, what should I be doing here? The logical idea would be to follow the current move in that direction and look for a long trade here. But what happens next? Maybe the trend continues and the previous day's high turns into a support for even more long positions. We do not know that. But in this case, price actually rejects the previous day's high level with a swing failure pattern. Then we see the internal structure shift that starts turning the bearish. So in the end, it makes more sense to look for short positions rather than trying to force longs here. You see, this is how we combine small clues together using liquidity, structure, and some imbalances to make smart trading decisions. So, if you are looking at any charts right now, should you be looking for the longs or should you be looking for the shorts? When it comes to longs, if you notice that the internal trend structure is clearly bullish, That is usually really a strong clue. Then you want to ask yourself, is the price moving towards a major liquidity like the previous week's high or set of equal highs? Then another small clue is when the imbalances are bullish and actually supporting the overall trend in the direction. That's basically how you should be looking and thinking about long trades in the market. Now, what about looking for the shorts instead? Okay, let's say price has reached a major level and that area is now being respected. Then you need to ask this: is the price is getting heavily rejected at that level with a large wicks or even swing failure patterns forming? But even that alone is not enough to jump into a short trade yet, because the trend could continue pushing higher and higher for a long time, and we just do not know that yet. What you really need to do next is look for a change in the internal trend structure. If the internal trend turns bearish and starts making new lower lows, that is an important shift. And that's when it becomes a much better time to start looking for short opportunities. So, these are the small clues that you want to pay attention to before trading any asset on the market. Let's talk about how to build positions based on our strategies and directional bias we have. As you already know, when we spot clear targets like the previous day's high, we always ask ourselves how the price could realistically reach that level. We usually look for cheaper, solid points of interest, especially things like the multiple imbalances. But sometimes that alone isn't enough. And that's why we also pay attention to supportive structures like the demand order blocks. This combination gives us a really strong area to build our trading setups. Our most classic entry model is opening a lower time frame and watching for some kind of structure shift. And honestly, this is probably the most common entry type you already know and we have been using for quite a while. The problem is that this method requires a lot of waiting and being extremely precise and patient with your timing. The alternative method is building a cost average inside your entry zone. For example, let's say we have a large imbalance area with this demand order block sitting right below it. This basically gives us a very wide and flexible entry location. So what you do is place your limit orders throughout that zone in a strategic way so you can build an averaged position. In reality, we have no idea how much the price might chop around or struggle inside that area. It could take a while. But the good part is you don't have to sit and wait for the perfect moment anymore because you're entering slowly and steadily. Let's check out everything in a real time and see how we can actually build these positions. Solana gave us a really clean example recently on the 4-hour time frame. We had the previous day's high sitting above the price as a clear target. And we also had this huge 4-hour imbalance area lining up with a demand order block. So overall, we already knew the direction and the possible entry area. And you can see how simple it looks, right? But if it is really that simple, why is it so hard to trade it? Because waiting for a structure to shift on the lower time frames takes a lot of time and patience. What I like to do is set 3 different limit orders right at the key spots. You can place your first order at the start of the imbalance, then your second order around the EQ of the imbalance, which also lines up with the support and resistance flip area. And finally, your last order can be placed right on the order block area, the demand zone. So what is the real benefit of doing this? The benefit is you're not waiting around for anything to enter anymore. You already placed your orders. But as you can see in this example, not all 3 orders get filled. The last one was a bit too low to trigger. And that's tough reality of trading. Not all your limit orders will get filled, but at least you are not glued to the charts waiting for an entry for hours and hours. Okay, so what is the other way to trade this? Of course, you can drop down to the lower time frames and watch for a structure shift. For example, on this 15-minute chart, you can see the shift in structure, the pullback, and then the rally towards the previous day's high. This is the most classic entry model we have been using for a long time. So, when you compare DCA cost average methods with the classic reward systems, there are a lot of things to keep in mind. The advantage of yo-yo is that you almost never miss an entry. With the classic reward system, you can easily miss any setups. With cost average, you are not waiting. Just set your orders and go about your day. But with reward systems, you have to wait for a specific entry. But the big issue with the cost averaging methods is that you usually end up with smaller profits and bigger, sometimes gigantic losses. With classic reward systems, you normally get better profits and smaller losses. And when you use DCA, you will notice something. You will get like 80-90% of win rate because taking quick profits with small profits. With classic reward systems, your win rates will be much lower due to the instant stop losses. Let's talk a bit about important price levels and how to handle trades when the price comes into these levels. For example, the first important question is, after this level is taken out, what exactly should we be looking for in that moment? How can we react properly as traders? What is really happening with price action around this level? Will this price level be broken with a strong momentum and then turn into a support and resistance flip area, like in these examples? Or will these levels act as a critical points that signal a possible reversal instead? So what clues and tips can we use to better understand what the price is telling us? First of all, if these levels are broken very strongly, there is a much higher chance they can turn into support and resistance flip points. For example, during a retest, you might notice a rejection wicks forming right at those support and resistance flip levels. This usually happens in continuation patterns where the price wants to keep moving in the same direction. However, if these price levels are broken and price immediately come back with large wicks or swing failure patterns, that has a different story. Once the price moves back inside the range again and keeps rejecting the same levels, there's a much higher chance of a reversal now. As you can see, this is not an extremely complicated way of looking at and reading important key price levels. Bitcoin had a really clean example recently. Once the price took out the previous day's low level, it briefly swept that area with a nice wick and then strongly moved back into the range. You can call this a swing failure pattern or simply a rejection wick, I don't care. The main idea here is that sellers were not able to push the price lower anymore, and buyers stepped in and reacted quickly. And in the next step, the internal structure was broken to the upside by the buyers. This clearly showed that sellers were very weak in the situation and buyers started to take control back. This was a solid trade example, and I noticed a couple of students on Twitter actually took this trade. I liked it. I honestly think it was a really nice opportunity overall. After that, price moved straight back up toward to the PDH, which is the previous day's high level. This was a classic move from PDL to PDH, or similar how the price often moves between PDH and PDL levels. So with this guidance, you can get a much clearer understanding of how the price may move around critical liquidity points. This also applies to any kind of structures like supply and demand areas, like order blocks where reaction often happen. Let's talk about how to take trades and shift our bias or direction on the fly as the price action keeps changing. For example, in a crashing market, when the price pulls back into a multi-imbalance area, usually lining up with a supply order block, what is the first thing we normally think? We naturally want to follow the overall trend and ride the move down with it, aiming for a clear target like the previous day's low. That idea is simple and honestly, it is usually the right approach. But the truth is, it doesn't always play out the way we expect. And if you get stopped out, that's completely normal. So when the order block and the imbalance fail and you get stopped out, what can you actually do next? What should be your next move? We have to start thinking about how the structure is shifting and how the internal trend might be changing after a big failure like that. What usually happens after you stop out is that the order block, that failed order block, and the imbalance can flip into a support and resistance zone. And it can actually help guide you your new direction toward a fresh target like the previous day's high above. And this is exactly how you adjust your bias and switch direction on the go when a trade fails or you get stopped out. Let's check out this Bitcoin chart. This setup is a mix of 1 and 4-hour time frames so we can get a clearer look at the price action from both angles. And we got some clean targets sitting above and below the previous day's high and low levels, with the price right now stuck in the right middle of everything, as you can see. So, Bitcoin has been in a pretty strong bearish move over the past few days and weeks, and this 4-hour imbalance is showing me that the bears are still in the control and pushing the price downwards. When you switch to the 1-hour chart on the left, you can see the 1-hour imbalance lining up with a 1-hour order block supply zone. Price also forms this inner liquidity level. So naturally, I'm expecting the price hunt that inner liquidity, tap into the multi-imbalance area with the order block, and drop into the previous day's low. This is option 1, and honestly, the most natural and likely move we could get. Our second option is that the imbalance and order block fails, flip backs into a support and resistance flip zone, and price goes after a new target like the previous day's high. As you can see, we created two clear options here. So I am expecting option 1 to play out. And if that fails, then I will look for the option 2. As you can see, option 1 played out really well. And this was the clean move that we were expecting from the start. Okay guys, this is how you build your trade plans on the fly before things happen. Now let's talk about the next day and what actually happens during that session. First of all, we get a new previous day's high and a previous day's low to work with. And when you check the 4-hour time frame, you can see a pretty clear and white imbalance zone sitting here. And if you drop down to the 1-hour chart on the left again, you will notice 1-hour imbalance lining up with an order block. So, what do we expect in a spot like this? Now, if I had to put my money on it, I would short this setup again. It looks almost identical to the setup we had the day before, right? What I expect is the price pull back into this multi-imbalance area, tap the order block, and then dropping toward the PDL, take out the previous day's low. The exact same play with the previous trade, right? And okay, next possibility is still on the table, which is more of a low priority option for me, is that the order block and imbalance fail, and price pushes higher to go after the previous day high. But as you can see, this time my first idea did not work out, and that main play to target the previous day's low completely failed. Instead, the imbalance and order block didn't hold and failed. and the price just shot straight up to hunt the previous day's high above. As you can see, it really does not matter how clean or how high quality your setup looks, because some days the trade will still fail. And you got to stay flexible and open-minded, enough to flip your direction and adjust your bias when the price action tells you to do so. You can't just walk in saying, I'm gonna hit the previous day's low all day long, I'm gonna take all the shorts. No, you gotta adapt to what the price is actually doing. Okay, let's take a look at this Ethereum chart and talk about price action so we can find the best possible trades to take. When I look at this chart, the first thing that really stands out to me is this clean SR flip area. This looks like a strong reaction zone and probably the best area where we could expect a solid price move. But at the same time, if you take a closer look here, you will notice that within this zone of multi-imbalances, there are already a few swing failure patterns that have happened. So the question is, do we wait for the SR flip zone to get tested? Or do we trade based on these swing failure patterns and multi-imbalances? Because honestly, both of these areas are giving us potential trade setups. So what is the best move here? The answer actually lies in the inner time frames, the lower time frames, and the smaller internal structure of the market. We need to pay attention to how the trend is developing inside those lower time frames and see what kind of price behavior is forming here. Alright, let's switch over to the 5-minute chart and talk about what is happening inside that inner area in more detail. So right now, this is our multi-imbalance and swing failure point. We already found this out using the higher time frames in the previous section. It also happens to line up with a master class amplifier level, which is the previous week's high. This is a pretty strong sign that a possible reversal could have happened here before the market pulls back deeper. Now the next question we need to ask ourselves is, do we have clear targets to move towards to? And yes, we do. We've got the previous day's high combined with this inner trendline liquidity as well. So we've got some clean, visible targets sitting above us. And right around our multi-imbalance and swing failure zone together with the previous week's high amplifier point, the inner structure began to shift. First, it formed the initial market structure break. Then it started creating more breaks of structures one after another. You could have traded any of those break of structures since there were imbalances inside them if you notice. Each one of those could have been a solid trade setup with nice opportunities. But what if you missed all those break of structure moves and you are super late to the party? After the previous day's liquidity hunt, the PDH might now start acting as a support level here, though we don't really know for sure yet. So if you took a trade here, like in this example, that is actually not wrong at all. You should always be open to taking trades when setups make sense. You cannot avoid every single trade setups out there. However, in this case, this trade did not work out if you can see. The inner structure actually flipped again, this time shifting into a downtrend. Take a look at it. You can see a market structure break followed by several more breaks heading downwards. So overall, what we did here was combine liquidity, imbalances, and the structure together using both high and low time frames to find the best possible trade setups available for us. Let's talk about how to read great price action using this amazing indicator called the ICT high time frame candles. This tool really helps you to understand the market movement on the hourly chart basis, especially when you are planning to trade or scalp in the lower time frames. First of all, take a look at this beautiful area filled with multiple imbalances. It is sitting right at a support and resistance flip line, which makes it even more interesting. In this tradable zone, confirming an extra swing failure pattern, like the one you can see here, really strengthens your price action setup. And if you can spot any strong breaks happening around that area, that gives you even more confirmation for your trades. It is honestly very simple to identify price action when you are using this indicator. Now let's move down to the lower time frames and take a closer look at the price action and possible trade entries. Alright, here on this 5-minute chart, this is the point of multiple imbalances, swing failure patterns, the SR flip zone, and the strong break area all lining up together. Now the SR flip looks a lot clearer on this chart. And the specific zone also includes something called a PDL amplifier, which you will definitely recognize if you've gone through the masterclasses. So toward the end, right around in this discount area, we got a really nice tradable location. Let's zoom in on this area and talk about how you can actually take trades here. The first thing I look for is whether we have a clear target below or not. And these relative equal lows make a really solid target to aim for. In our trading zone, if you take a closer look, there is a clear 5-minute market structure break going down. And that right there is your signal to enter a trade. Now, in my opinion, the perfect entry location would have been around this imbalance area. But unfortunately, price never pulled back there. In situations like that, you should still consider entering when the market structure breaks. Just make sure your stop loss covers that imbalance zones. If you missed the first entry, no worries. The next thing you can do is look for more structure breaks or new imbalance areas to catch another trades. Also notice how those relative equal lows have now turned into a clean trendline liquidity area. That's another setup worth paying attention to. So at the end, this was another 1.5-hour trade. Now, these trades didn't bring huge profits like 2+ hour setups, but they were still good enough to be tradable and make some cash. Finally, let's talk about why the price reacted exactly at this point and started pushing back up. What was the reason behind that move? If you go back and look at the earlier charts with a wider perspective on especially 1-hour time frame, you will notice a perfectly shaped parabolic liquidity lining up with a large imbalance zone. And if you have taken any masterclasses before, you already know that these spots are usually perfect target zones and the reaction zones as well. Notice how the price reacted beautifully right here. So, what we did here was combine liquidity, imbalance, and the structure all working together to identify trade zones and take some solid entries. With the start of 2026, we are finally starting to see much clearer price action after that really rough December. By using our simple ICT high time frame indicator, we can once again spot some very solid trade zones to look for great entries. Especially this multi-imbalanced area in the middle, I've noticed that many followers on Twitter picked up on the same idea. On top of that, we also have these very clear SR flip points that helps us pinpoint specific entry locations. And if you look at the overall price action, we are clearly in an uptrend right now. Price started around from 87K and has been rallying up towards the 93K area. So now let's drop down to the lower time frames and talk about what we can actually do with a chart like this. From the higher time frames and by using our indicator, we already know this is a multi-imbalance area with an SR flip location that offers a strong trade opportunities. And right before our entry model, you can see these very clear equal lows, which can act as a perfect inducement point, which is also called IDM. So overall, this trade area is a strong field location and one of the best possible zones to look for a clean and clear setups. So what we are going to do next is zoom into this area and talk about how it can actually be traded. First of all, you can clearly see the market structure break right after the price pushed strongly into our solid entry location. So probably the simplest and the most straightforward way of trading is jumping into a trade right after the market structure breaks and setting a stop loss that is large enough to handle possible deeper pullbacks later on. Your second option is waiting patiently for the pullback so you can aim for a better entry and a higher target with bigger potential rewards. And if you look at the multiple other time frames, you can clearly see that there are some great imbalance points that can help you time your entry much better. And finally, your last entry model could be waiting for a couple more confirmations before entering the trade. For example, you might wait for the first break of structures and then wait another structure break right after that. So double structure breaks usually mean that the price is now trending. We have a much stronger confirmation to work with. These were your three basic and the most common entry models that you can use in trading. But I always get the same question from traders over and over again. I cannot sit and wait in front of the charts all day for my entries. And I get it because this is a tricky and very time-consuming process. If you do not wait for proper setups or a clear structure changes, you are basically limited to one kind of trades, which is the cost averaging methods, and nothing else. For example, there are three very good areas on the chart where you could place your limit yo-yo orders. The first one is the level of inducement, which is the equal low area, because price will probably crash down and sweep this zone before making a strong move. Then you can place another limit order inside your SR flip zone as well. And your final order could be placed at the fulfillment of the inner imbalance area for extra precision. So when you trade any type of cost averaging or scaling based strategies, you also need to have a clear mental stop loss in the place. For example, imagine all your limit orders get filled, but the price does not react at all and just keeps crashing through the area. In that situation, you cannot keep cost averaging forever, especially in trading. And there must be a clear point where you stop yourself. There should always be some limits in place where you mentally decide to cut your losses. For example, if all the structures, in this example, bullish structures are broken and price is not moving in your direction at all, that is your biggest and clearest clue that it is time to cut the trade and walk away. Breaker blocks come up often, so I want to do a quick recap and show how you can find some of the best ones directly in the price action. In reality, breaker blocks are not that complex concepts at all. Quite the opposite, they are actually a very simple price action idea. A bullish breaker block is generally the last consecutive bullish candles before a trend reversal to the other side. For example, in this chart, the final bullish candles before the market reverses upward becomes our bullish breaker block. It's that simple. Interestingly, breaker blocks are basically just support and resistance flips, Once you see them this way, identifying them becomes much easier. When you combine breaker blocks with internal imbalances, you start to build a very powerful smart money framework here. Let's look at this example. Notice two consecutive bullish candles. This area becomes our breaker block. Why? Because this is the zone where the market broke structure upward and the previous downtrend transitioned into a bullish trend, a reversal here. It also happens to occur at a natural support and resistance flip location as well, which strengthens the setup. In fact, some of the most SR flips can be potentially act as a breaker block areas. So this raises an interesting question. Can you build a single time frame setup based purely on higher time frame structures just like this one? For example, a simple 2-hour compact setup? The answer is yes. While it won't work every single time, it can be a practical approach for traders who prefer a simpler process and don't have time to monitor multiple time frames and so much free time on their hands. However, if we want better results in our trading journey, we need to look at combination of multiple time frames. For example, you might find your breaker blocks on higher time frames charts first. Then you can move down to the lower time frames such as minute-based charts to observe the inner trend and the market structure. By doing this, you are essentially combining higher and lower time trends to determine a trade direction that can be far more reliable than relying on a single time frame. Now, if we go back to our example and this time move down to the 15-minute time frame, you will notice something interesting. Inside the higher time frame breaker block area, we can see an inner break of structure along with an imbalance on the lower time frames. What this means is that the higher and lower time frames are now aligned. Both are showing a bullish trend upwards. So in this example, our first setup was based purely on a higher time frame analysis using the hourly charts. But our second setup combines both higher and lower time frames, essentially using the hourly chart for context and lower time frames for confirmation entry. If you trade using only higher time frame setups, there are actually some benefits there. You will find setups more quickly, and it is generally easier to identify potential entries. However, there is also a downside. Price action can become quite unpredictable because a pullback might continue much longer than expected, since you never confirm the entry with lower time frame structures. On the other side, when you combine both higher and lower time frames and align the trends together in both time frames, you can achieve better trade accuracy. But this approach introduces another challenge: waiting time. You may need to wait for hours for the lower time frame confirmation entry, which is significantly longer compared to trading a single time frame. As you can see, every trading approach comes with its own advantages and disadvantages. So ultimately, the way you trade should depend on your availability and your daily schedule in life. So with the new year starting, I'm expecting a much better price action after that really horrible December we just went through. What I want to do is here to teach you why you should not get stuck on a single bias and why you need to adapt market conditions in a dynamic way. Generally, when a market crashes badly or stays in a strong downtrend, we need to follow the flow because that is usually the best overall approach. And using multi-imbalance areas with SR flips is a great idea because price love to flow towards open liquidity areas. So, as an experienced trader, this should be your logical and expected move, which is downwards. So, as an experienced trader, this should be your logical and expected move, which is downwards toward the open liquidity points. However, this is exactly why I always talk about combining imbalances, liquidity, and the structure together, because that is the best idea for trading. If the inner upper trend is not broken and keeps going upwards, it means price is still looking for another set of liquidity above. So you cannot just blindly short every short setup. if you do not get enough confirmations in these markets. And the easiest confirmation to watch would be the lower time frame structure. Keep a really good eye on the lower time frame structure before taking any kind of trades. In Bitcoin, we had a really good example of this recently. There was a significant multi-imbalance area with a clear SR flip location. Logically, I was thinking, can we move lower from here and push towards this significant liquidity point? But that actually never happened because the lower structure, as you can see here, was never broken at all. If I had seen strong breaks downwards followed by a couple of structure breaks, this could have been a great short opportunity. But instead, if you carefully look above, you will notice the relative equal highs sitting up there. That was a strong reason for the price keep moving higher to take out that liquidity. And the inner structure was never broken and just keep pushing upwards. Because of that, we need to shift our thinking and realize we are going higher, not downwards. This is how you dynamically change your bias in the markets. You need to combine nearby liquidity levels with how the inner structure is moving towards those liquidity points. As you can see, you cannot trade what you think. You need to trade what you actually see on the charts. Let's talk a little about market structure and price bias and how both of them can shift pretty quickly. As you can see on the higher time frame chart, there is a clear 4-hour imbalance that lines up with a 4-hour supply order block. After some time, you can spot that inner swing failure pattern, and it sits right around that overall support and resistance flip area. And down below, we can also see the previous day's lows sitting right next to those equal lows. So naturally, what should we expect here? A pretty strong drop, a crash, because all the main price action concepts are pointing in the same direction, the bearish movement. To put it really simply, we are in a bearish market if you take a close look, since price keeps making new levels of lower lows. And if you look even closer, you'll notice it keeps following the straightforward pattern of using imbalances and supply order blocks to push down into the next leg. And when you keep following that pattern, you can see it actually played out the way we expected at the end. Price dropped and wiped out that previous day's low. But what happens inside the lower time frames like the 5-minute and 15-minute charts? What usually happens is actually pretty obvious. The inner trend, the structure shifting right at the point where our high time frame interest area sits. However, when you build your setups, you want to stay as tight and as clean as possible. A good rule of thumb is to use 1:2 ratio at maximum. And the reason is simple. We never really know how long the price may stall in that zone before taking out the previous low. We have no idea. Sometimes it can take only a few hours and some other times it can take many days. Okay, let's get back to the higher time frames again and talk a little more about what is going on. Yes, the price is clearly crashing, but at the same time it is building up a pool of liquidity above, creating this kind of parabolic liquidity along with a weak empty imbalance string on top. So how do we know when the trend is about to change? That's the big question everyone always asks. It usually starts when the bearish structures begin to fail, like when imbalances are not holding anymore or order blocks stop reacting or similar structure breaks. Then you will see a shift in a structure with a clear market structure break. And all of that together becomes a pretty strong sign that price action may be shifting and overall trend could be turning at this point. So basically, if you get stopped out while following the existing trend, you gotta ask yourself why that happened. because most of the time it's a great sign that the trend might be getting ready to change. If you look closely at this example, you can see the price was following a simple pattern of tapping into inner imbalances and reacting to supply order blocks, and that kept driving the market downward in a steady downtrend. But if at any point that bearish structure suddenly fails, you should start thinking that something is shifting here. It might be buyers stepping in and rejecting the price levels, hinting at a possible trend reversal to sweep that parabolic liquidity sitting above. And this is how you should look at these crashing or fast running markets, and how you can expect a trend flip at any moment. Let's have a quick talk about this Bitcoin setup by using our favorite tool, the ICT High Time Frame Candles Indicator on TradingView. When you apply this indicator, you can immediately spot multiple imbalance zones and quickly identify a good entry location. As you already know, we recently went over swing failure patterns. But if you carefully look at this 1-hour chart, you will notice at least 4 or 5 tricky and fake swing failure patterns showing up. That's the main reason I always encourage you to combine multiple imbalances with multiple swing failure patterns. This is really the only way to avoid or at least reduce those fake imbalance areas or SFP zones. Now, when we look at this SR flip area, the picture becomes very clear. Right here, you can clearly see a multi-imbalance and multi-swing failure point coming together. But it is not just the SR flip area. It also acts like a powerful amplifier because we have the previous week's high sitting right there as well. And above all that, we have a super clear target. That's the PDH, the previous day's high area. So let's zoom in on this area and break it down further. First of all, right under the previous day's high, you can clearly notice that a parabolic liquidity has started to form. This formation creates an additional liquidity area that you can use as potential spot to hunt for trades. Later on, what really happens? The market structure breaks and the price dips down into this imbalance area. This area is sitting right at the EQ point of between a premium and discount zone. If you look closely, you can clearly see the breaker block already here. This is one of our old and familiar smart money concepts. Then you took this trade. It turned out to be a clean setup, giving us a solid 2-to-1 risk-reward ratio. However, there is one issue with this trade, and it is something one of my students actually asked me about. If you look at the chart below, you will notice this trade took nearly 8 to 9 hours to fully play out. Now, as a day trader, it is perfectly fine to take just one solid trade per day because it is day trading. After all, you are a day trader, so that approach makes sense. I don't see a major problem with it. But here is the question. What if you are aiming for shorter time frames? What if you are more interested in quick scalping opportunities instead of holding trades for hours? So now let's zoom in the area even closer and break it down one more time. So, if you want to trade in shorter time frames, like under 1 hour, 30 minutes, or even as little as 15 minutes, the only real solution is to use closer targets along with tighter stop losses. This is the only practical way to get shorter trades done successfully. What you do here is actually quite simple. You just follow the trend. With every break of structure, you look for opportunities to take small trades, setting closer stop losses and closer targets. Just like you can see in these examples. But here is the challenge. When you trade this way, you run into big problems. That's because when you take micro trades, you are going to be stopped out quite a lot. The only way to balance this out is by making multiple trades during the day. You might need around 4 to 6 trades in a single session to finish the day with a positive net results. Let me break this down and explain it even simpler language along with some clear visuals. First, you need to find the direction of the market, the bias. You must have a bias. For example, let's say you spot an area with multiple imbalances and several swing failure patterns. That area becomes your entry zone, the area that possible reversal starts. At the same time, you also need to identify a clear target at the top. Now you have both a direction and a trading bias. This is the first step. So, as a regular trader, you might set up one big trade with a large stop loss as a day trader. That's the classic approach of taking one single trade per day as a day trader. However, since this type of trade usually takes a long time to play out, if you want shorter trades, basically scalping, you need to write the trend from your entry zone all the way to your target zone. And instead of waiting for one large move, you start taking micro-scalping trades along the way, each with smaller targets and tighter stop losses. But as I mentioned earlier, micro trades comes with a major problem. You will get stopped out too often. So the only way to make this work out is by taking at least 3, 4, maybe even 5 or 6 trades in a single day, so that overall you can still achieve a net positive result with these micro-scalping techniques. Let's take a moment to talk about market structure and how we can improve the way we read the markets. For example, if you look at the Solana chart, you can clearly see that we are stuck in a very strong downtrend. We keep making new bearish breaks to the downside, showing that sellers are still in the control. So, this is a very obvious and easy to spot downtrend when you look closely. Now in this situation, we have two important targets. The first is the PDL, which is the previous day's low. The second is the PWL, which is the previous week's low. The big question is, are we going to see a reversal after the market hunts these levels? Or will the price just continue pushing lower? How do we recognize whether it's a true reversal or simply a continuation of a downtrend? Let's break that down. For example, let's say the price hunts the PDL level, the previous day's low. After that, if we notice a clear break in the market structure, maybe even the very first break of structures together, the combination could signal the start of a strong reversal. On the other hand, if the markets keep dropping, creating large bearish imbalances, and breaking the structure to the downside again and again, then that's a clear sign of the downtrend is continuing. Another thing to watch is the PWL below the previous week's low. You will notice the price often gets pulled toward this level almost like a magnet, dragging it lower and lower. Finally, one more thing to pay attention to is multi-time frame imbalances. For example, look at the both 30-minute and the 45-minute charts. When you see imbalances lining up together and the price taps into those areas before pushing down again, it makes the downtrend even stronger. Okay, so how do we figure out the point of interest, the POE, and the entry areas in these downtrends? Let's go ahead and talk about that right now. Notice three very clear things here. First, we have this big imbalance area. And right above it, we can see the order block, which happens right around an SR flip and a PDL amplifier. So this yellow circle marks an extreme point of interest for me. If you set a limit order here for a 2-hour setup, I think that's a pretty reasonable and acceptable move. But here is the thing. After just a small pullback, if you watched closely, price started to push down really strong, breaking through the lows of candles like this one. That tells me there's a good chance of price might not pull back again, and sellers could be taking full control of the move one more time. So what do we do in a situation like this? Well, first of all, this is not my perfect entry spot or POE at all. But you could still set a very small risk trade here, maybe a simple 1-to-1 ratio. Then set your real limit order above for a 2 full hour setup. You see, the market is not always gonna give you the exact perfect entry you want. Market does not owe us anything. It can do whatever it wants and whenever it wants. And that is something we all need to accept it. Now, after the PDL and also the PWL, the previous week's low gets hunted, we are left with two possible outcomes again. One possibility is a reversal. Maybe a market structure break and even the first break of structure combined. The other possibility is continuation, where we see a strong push down with a bearish imbalance forming. As you can see, reading the market isn't really as complicated as it might look at first. The markets are always moving in a mix of just three things. Do not forget this. You need to always consider these three things: liquidity, imbalance, and the structure itself. This is how the markets move. Recent price action in cryptocurrencies, especially the big drops in the major coins, is giving us some really solid short opportunities right now. And thanks to our ICT high time frame candles indicator, we are able to clearly spot some very usable and high probability trade areas. For example, in this case, Ethereum had this amazing multi-imbalanced area that was perfect to start looking for trades. And that area was also combined with multiple swing failure patterns lining up together. So by using our indicator, we quickly identified this zone, and then we used the price action concept called the swing failure pattern to further confirm and fine-tune our great entry areas. Now, when you drop down to the lower time frames like 5 or 15-minute charts, you can see the price action much more clearly and really understand what is going on behind the scenes. First of all, notice how the SR flip point works beautifully in this example. And it's not just a simple support and resistance flip, because it also lines up with the previous day's low area that is pushing the price level. This is kind of a masterclass amplifier. So when we zoom out and look at the big picture, what we have on the higher time frame is multiple imbalances combined with the multiple swing failure patterns stacking together. And on the lower time frames, we can clearly see a strong and significant SR flip aligns perfectly with the previous day's low. Now, this is what I personally call a magnificent A++ price action setup that we can consistently find by using our indicator. And the next question is how we should actually treat this kind of setup in a real trading situation. Of course, the next step is to look closely at the lower time frame structure and see what is really telling us. As you already know, trend reversals on the lower time frames usually begin with a clear market structure break, the MSB. After that, you should also ask yourself where the price is most likely heading next. And this bottom, especially when it forms in a parabolic way, we can push the price into certain areas that could become great targets for us. Now, what usually happens after the first market structure break is the trend continues and becomes more dominant by making a second break of structure. At that point, you're basically looking at a strong, clear downtrend. And in that area, you can often find the nice imbalances and small zones that give you solid scalping entries on the 1 minute, 5 minute, or even 15-minute time frames. Now, the most common entry is getting on the market structure break combined with the inner imbalance. A nice 2-hour setup in this situation can be very clean and very attractive, as you can see. However, the problem is that market structure breaks, the MSP, can be fake many times because shifting a trend and changing the structure in the opposite direction with a first MSP is not an easy task all the time. So, if you find yourself getting stopped out again and again and again by trading on the microstructure breaks, that usually means you should wait for the dominant trend to form first. And the first sign of a more dominant trend is seeing a second break of structure after the initial MSP, the market structure break. So sometimes it is actually smarter to skip the first trade and join the trend later with additional structure breaks, like in this example, which are usually much stronger and more reliable. Let's talk about the recent price action and how we can break down the technicals in this chart. The first thing you probably noticed is that the price was clearly pushing in one direction. That move lined up with the previous day's high and also connected with this 4 hours high. And if you look to the left, you will see that we got a set of equal highs sitting here together. So it was pretty clear that the price was working its way upwards. And imagine that based on the technicals you just spotted, you decided to take a trade. You took something like this simple, a compact, small 1.5 hour setup, basically a set and forget kind of trade. Now this trade could have lost or maybe not played out at all. What matters is that you outlined your plan and followed it. Now let's zoom in on the price action and really think about what actually happened here. One of the biggest questions is, what does the current structure look like before the trade? If you look closely at the price action, it keeps forming new higher highs and it moves upward. And basically the buyers are stepping in, taking control of this move, pushing the price higher. This part is pretty clear. And next, we already noticed the most likely direction where the buyers are trying to push the price. This lines up with the previous day's high, the 4-hour high, and those equal highs all forming together. And finally, we've got this interesting imbalance sitting here. If you take a careful look, you can see that it is completely filled. And if that imbalance holds, this could be a solid place for me to put my stop loss for the moment. It is actually a very simple idea. If the bullish structures keeps holding, we are most likely keep going up. However, if the bullish structures start to fail and one after another, it is probably sellers taking the control. It is a super simple concept that you can use in your trading and thinking. In the end, this is not an amazing trade as you noticed, because you don't really have much room for a nice reward when your stop loss is pretty big. But in trading, this is where things get tricky. You can't expect big rewards all the time. Honestly, most of the time you won't get them. And that's why I always say to keep your rewards tight, realistic, and compact as much as possible. Because at the end of the day, it is much better to lock some profits than wait forever and end up losing the whole thing. Today, let's talk about changing bias and what kind of price action we should pay attention to when we are thinking about shifting our directional bias. If you look at the Solana chart on 3-minute time frame, you will notice two distinctive liquidity levels. At the bottom, we have the previous day's low and the previous week's low together. At the top, we have the previous day's high. We also have this relative equal low string below, acting as some extra confirmation for our directional bias. And we got this small parabolic liquidity string above, combined with the previous day's high. If you check out 4-hour chart on the right, you will see this gigantic bearish imbalance right here. This becomes important because it lines up with a very specific price action zone. Price sweeps the inner liquidity and reacts to this inner support and resistance flip zone. So what should we expect here? In my opinion, we should be looking to take a short trade right here, because this is what I'm expecting to play out. This feels like a solid idea, and it lines up nicely with all my patterns and concepts. But the reality is pretty cruel, because you can have a strategy that wins 90% of the time, but it can still fall apart on you. As you can see, this trade and the price action ended up failing really badly. This 4-hour imbalance was completely broken and it didn't work the way it was supposed to be. Instead, we are now seeing a strong bullish imbalance forming on the 4-hour time frame upwards. Then this happens. When you look at the structure, you can see it making new breaks one after another, pushing higher toward the target, which is previous day's high. This gives you endless small imbalances inside to move, letting you take a quick little trades along the way. So how do we adjust our directional bias on the fly? And what should we actually pay attention to? You follow the imbalances and liquidity and you connect all of that with the structure. For example, inside this big hourly bearish imbalance, we would normally expect the price to follow the structure and trend, dropping and crashing badly towards the previous day's low. This is what should we expect. This is the natural move here. However, the big bearish imbalance fails like in our example and the inner structure starts breaking upwards with a strength. We need to be extra careful and think about our bias. It becomes very likely that the trend or directional bias has shifted now, and the price might be hunting a new target such as the previous day's high above. So when you are trading, do not get stuck on a single bias. Price is constantly moving and can switch targets within the same day. There's nothing fixed or guaranteed in the markets. You need to adjust to whatever is actually happening in real time. Check out this Bitcoin chart. The first crash happened right at this multi-imbalance point. Then I was watching the second multi-imbalance point expecting another drop from this fair value gap area, possibly all the way down to the 90Ks. The structure looked almost identical, both showing similar swing failure patterns forming together. But this time the pattern didn't play out the same way. The big crash never came like before. Instead, we saw a strong pullback in the opposite direction. So, what actually happened here? When I started checking the lower time frames, I noticed this nice PDL level showing up below. It was lining up with a clean equal low that looked like a clear target area at the bottom. My trading plan was pretty simple. After the price reacted to that multi-imbalance point from the high time frames, I waited for a structure shift in the lower time frames and looked for a quick 2-hour setup. At first, the trade was actually going great. It almost reached a 1.5-hour profit. But then things started to slow down and eventually the trade failed. And now you might be asking yourself, why? What went wrong? But honestly, there isn't always a clear reason. Every trading strategy, no matter what, how good it is, it will sometimes work and sometimes fails. So there is no such a question you should ask, why? Why did it happen? It is just the reality of real trading. And then there was this Nasdaq chart that showed up a big multi-imbalance point right in the middle. It was supported by several swing failure patterns, along with the small support and resistance flip point. Overall, it looked like a perfect area to look for a short entry on the lower time frames. As you can see, this is the exact same chart with the Bitcoin. When you zoom into those lower time frames, you can clearly see the equal lows right below. Another clear target, an obvious target for us, just like the Bitcoin chart that we previously looked at it. At that multi-imbalance point, the market swept all the inner liquidity and then shifted the structure downward. After that, the market just kept dropping until it completely cleared those equal lows. Now you might ask again, why did that happen this time? And honestly, there isn't always a clear answer. Most traders keep asking, why did my trade fail? But they rarely ask, why did my trade win when things go right? The truth is, markets can move in a pretty random ways day-to-day basis. Any strategy, no matter how solid it is, might perform amazing one week and then completely fail the next week. But if you keep applying the same approach, concepts, and patterns consistently over time, you will build a statistical edge that can actually make you profitable. Let's take a look at this interesting Bitcoin setup and talk about how we can approach taking better trades. First of all, you can clearly see that the price pulled back into this big imbalance zone, actually tapped into 6 different imbalances altogether. Now, at first glance, it looks like several swing failure patterns showed up. But in this case, most of those swing failures ended up being fake outs. If you take a closer look at the area, you will notice multiple swing failures formed again and again and again. And honestly, almost every single one of them faked traders out, including myself. Sometimes it is impossible to avoid these fake outs. So, is there really a way to avoid these fake outs? To be completely honest, not really. Some days you are going to lose trades no matter how good your setup looks. At the end of the day, once you are in a trade, only God knows what's actually going to happen next. There's no such a thing as 100% success rate. It is just impossible. Now, let's dive deeper into this area and talk about the lower time frames and how we can think about taking some kind of entries here. Now, what you are looking at right here is the 5-minute Bitcoin chart. We are focusing on the area with multiple imbalances and a bunch of fake out swing failure patterns. The very first thing that stands out is these equal highs above us, which gives us a clear target. It also lines up perfectly with the previous day's high. So in this trade, we actually have a very obvious target sitting right above us that gives us both our target and our bias. We know that price is moving upwards, but we do not know exactly when or how it is going to get there. Sometimes it happens instantly. Sometimes it takes an hour, and in some cases it may take even days. Now, if you look down at the bottom, in the same area, full of imbalances and fake swing failure patterns, you will also notice this 5-minute inner imbalance. That imbalance actually helping to support the price. Then you saw this inner structure break at the area of with multiple imbalances. That is the moment that when you enter this 2-hour setup. And let me tell you something, there is absolutely nothing wrong with this setup. This is what I could call a really great trade. Sometimes it is just impossible to avoid losses, and that's just part of trading. If you are always waiting for the so-called the most perfect trades ever, you will never end up taking any trades at all. You need to take the risks. You got to learn to accept the losses as part of the game. But let's step back and talk about what we could have done differently to maybe take a slightly better trade here. The first thing we could have done is use a larger stop loss. But why? Instead of putting the stop right under that swing point, we could have made it wide enough to cover this entire 5-minute imbalance. That would have increased our chances of staying in the trade. The second thing you could have done is go back to basics to create a cost average for yourself. This method works especially well for the people who keep getting stopped out every single day. By using cost average techniques like my masterclass yo-yo technique, you can improve your win rate and avoid a lot of unnecessary stop losses. But keep in mind, the downside is your profits will usually be smaller compared to running a regular risk-reward setups. Let's look at the conflicting trading ideas and go through some clues on how to avoid taking bad trades. When I was looking at the Solana chart with this multi-imbalance area, I honestly thought this was a great possible location to look for longs. And it wasn't just that either. There were also three very clear and identical swing failure patterns on the chart. So overall, this looked like a great spot where the buyers could potentially step in again and ignite a second leg of the rally right here. Now let's drop down to the 5-minute chart and talk through this setup in more detail. This is the multi-price action location that we just identified on the hourly charts. When I first saw this, I noticed this internal market structure break followed right away by this inner imbalance area. And this was a solid 2-hour trade setup. At first, this trade actually looked like it was working really well and even reached 1-hour profit during the move. However, by the end of the day, this trade failed pretty badly. Even though we had what looked like a high quality setup here, we missed something important, and that's we really need to think about and question right now. Now, when I was looking at this chart from a different perspective, I also noticed that the previous day's high had already been hunted. However, on that previous day, the high did not really act as a strong support area at all. So what happened here is that the buyers simply did not have enough strength or momentum to push this price even higher. Instead, what we got was a clear counter market structure break right after the previous day high was hunted. And that alone already gives us an idea of a potential short trade opportunity here. But we actually took a long trade instead. So sometimes it can be really hard to avoid this kind of conflicting trade ideas, and it is human nature to miss things and make mistakes. So never do not worry about this kind of mistakes in your trading career. Okay, what I want to say here is that institutional levels like the previous day's high and low or the week's high and low can sometimes be very tricky areas to trade around. As you already know, we normally expect price to hunt these levels, especially when the price is trading very close to these zones. However, once that area gets hunted and liquidity is swept, there are usually two possible outcomes that can follow. First of all, in many cases, these institutional levels can act as a strong support or resistance areas, and the obvious trend may simply continue in the same direction. That is exactly what I expected to happen on the Solana chart we just analyzed together. However, many other times, we see a very clear market structure break after those liquidity levels get hunted. And that break of structure is usually followed by full trend shift where the direction completely changes at all. So imbalances and liquidity alone are not enough to build the high probability trade ideas. You also need to clearly follow and carefully analyze the overall market structure if you want the best possible trade setups. We will continue working on our simple multi-time frame indicator to find great trade spots and learn how to use these interesting trade areas. According to our multi-time frame, I see the high time frame indicator. This in the middle location is a great location with multiple imbalances points. This area gave us an opportunity to look for trade entries on the lower time frames. Now let's check out the 1 hour time frame in detail and talk further about this trading area. In this multi-time frame, multi-hour imbalance area, you also have a nice SR Philip point. But this is not an ordinary point. It was also the previous week's high and acted as a masterclass amplifier. And if you look below, the overall trend had already changed the upside before. Because of that, I can side with bulls and the buyers. Notice how the structure changed days ago. Price kept making higher highs. When you see price taking out previous highs one after another, it shows strong buying power. This acts as a form of confirmation for an uptrend. Now let's check out this area on the lower time frames and talk further. Now we drop down to the 5-minute time frame in our trading area. What you see here is the first clue that you can get. Look at how nicely the internal liquidity is building up. Sometimes people ask me, what is an inducement, the IDM? An inducement is this liquidity building up in the areas right before your trade entries. What happens here is price makes a small crash to sweep all this liquidity and fill up before a big movement. If you look to the left, it hits this internal SR Philip point. This area is also a structured box with a protected low. So what you are seeing here is actually a masterclass level A++ setups. So many masterclass level I teach comes up here. And this does not happen every single day, but this is an extremely clean price action. Now after this, things get a little bit more interesting. Before entering any kind of trade, it is always good to see a structure shift in your favor and in your trading bias. What happens here is the first market structure shift shows up right here. This gives you the first trade idea along with the internal imbalance. But like I always say, sometimes the first structure shift can be tricky. You might miss it if you are doing something else as well. That's why it's always smart to wait for the first break of structure right after the market structure break. This acts like a double confirmation here. Then your secondary trade could look like this one right here. Unfortunately, there is not much to do about waiting long times. If you want to be a trader, you need to accept that you need to spend a solid 3, 4, 5 hours in front of the computer to make any kind of money. There's no other option here. Let's talk about how to take the perfect loss using A++ setups in real trading situations. Sometimes it is completely okay and even necessary to take a loss in the markets. When you look at this Bitcoin chart, we have this really clean and impressive multi-imbalance area forming. On top of that, we also have a clear swing support and resistance Philip pattern showing up. And at the same time, there was a very clean swing failure pattern that developed right here. So, what you are seeing on this chart is a true A++ area to look for trade entries in the lower time frames. I talk about this a lot in my free YouTube videos and in my master classes as well. I consistently show how to find these clean and beautiful trade areas and where the trades make sense. Now I drop down to the 5-minute time frame so we can break this down even further. First of all, you need to understand how important this SR Philip really is. What happened here is pure price action at its finest. Price came into this exact level and got rejected 3 different times. This area was a very strong resistance zone at that moment. Once this zone finally broke, it then turned into a solid support area. This right here is the core idea behind SR Philip trading. And if you look above this area, you will also see the PDH, which is the previous day high level. The target area also shows a clean triple equal high structure. So everything about this chart is honestly screaming one thing. This is one of the best A++ trading setups that I teach. Now I am going to zoom in on the entry location so we can talk about it in more detail. As you can see, price started forming this small inner trend and then pushed aggressively towards the SR Philip and the multi-imbalance area. So basically, price was just pulling back here to reload and build momentum inside in our multi-pattern zone. Once price tapped into the SR Philip and the multi-imbalance location, which you can clearly see right here, buyers stepped in and completely shifted that inner trend. And right at that moment, it opened the door for a really solid trading opportunity. So this was a perfect trade setup with A++ patterns lining up very cleanly. Even though the reward on this trade was somewhat small, it was still a very high quality and well-defined setup. The issue with this price action though was that price pulled back very aggressively right after our entry. It almost came back far enough to hit our original stop loss, which definitely adds a mental pressure. In situations like this, cutting your loss halfway and protecting part of your risks makes a lot of sense. By doing that, you can save the remaining 0.5 R and only take a 0.5 R loss instead of the full one. In the end, this A++ setup actually worked exactly as I expected with all the patterns. There was nothing technically wrong with the setup itself or analysis behind it. That said, it is completely fine to cut your losses early. When you see an unusual strong pullbacks after your entries, sometimes your emotions will kick in and push you to make faster decisions than planned. And there's nothing wrong with managing the trade that way simply losing less than normal. At the end of the day, protecting your capital and staying consistently is always okay. Today, let's talk about how to read price action in detail by looking closely at the market structure and explore different ways of understanding how the price moves. As you can see in this Bitcoin chart, the price first hunted the PDL or the previous day low before quickly rallying back above to take out the PDH, which is the previous day high, along with the previous week's high level. At the top, we also have these equal highs forming together with the PDH, creating a clear point of interest. And down below, we can see the PDL combined with the equal lows, giving us another strong level to watch. You will notice that both sides were heavily manipulated, with liquidations taken out on each end. After that, the price pulled back into the center zone once again. This creates a kind of range and deviation, which you might remember from our free trading course on smart money concepts. Now, let's deep dive into the move from manipulation to manipulation and break down how the market structure really works. Now we are looking at the same chart, but this time we are using the 1 minute time frame. If you take a look at the bottom left, you can clearly see that price was in a strong downtrend, pushing lower to take out the PDL, which stands for the previous day low, while continuing to make multiple break-off structures. After the PDL was hunted, a reversal started to form, and the trend began to shift direction with a clean market structure break. Then what happens next is the first real break of structure, and it comes with an extremely nice trade setup. These moves also happens right around an inner support and resistance flip area combined with an imbalance in the market. Like I always say, sometimes skipping those very first market structure breaks can actually be more beneficial because the reversal may not happen immediately. But when you spot that first confirmed break of structure, it often gives us much better trades, just like we see this example. From here, the trend kept moving upwards, creating new break-off structures again and again, all the way until it reached the previous day's high. Now, as you can see, the previous day's high has been hunted right here. And the question is, will the price reverse at this point, or will it continue even higher? As you know, just because the price takes out the previous day's high or low, it does not mean the market will instantly reverse. The move can keep going, pushing further and further without stopping right away. In this example, you can clearly see that there is no real market structure break for a reversal. That means the trend hasn't shifted from an uptrend into a downtrend yet. Instead, the price keeps breaking structures to the upside, climbing higher and higher as you notice. At the very top, we also have the previous week's high just sitting there waiting to be hunted. This is one of the main reasons why the price continued pushing upwards in this example. Now, once both the previous week's high and the previous day's level taken out, both of them, that's when we finally start to see the first clear market structure break. This becomes the very first sign that a possible reversal might be forming. Right here, what you are looking at is an inner market structure break shift that happens again. This actually creates a possible long opportunity in this example. It's not a bad idea because the PDH, the previous day high, acts almost like a strong amplifier for the move. But in these trades, there is one issue. The PWH, or the previous week's high, has already been hunted. Because of that, our upside targets are now much more limited. And this is exactly why I often say that waiting to see the first break of structure after a market structure break gives you more comfort and confidence in your trades. At that point, we know the trend change is more likely confirmed. So in this example though, the inner market structure break turned out to be nothing more than a fake move. Instead of reversing, the trend continued pushing downward. Reading the markets can be tricky because there are so many fake movements and fake signals. That's why I always emphasize focusing on clean and solid targets like PDL, PDH, and PWH. These levels can help confirm your bias and give you a clear sense of direction. And when you combine multiple structure confirmations with a strong trend, your trading decisions become much more reliable in my opinion. Let's talk about the recent price action in Solana and do a full top-down analysis starting from the weekly chart. If you take a closer look, Solana has been in a very strong, almost unstoppable rally over the past few months. It moved all the way from around $120 up to $240, basically doubling its price. Now, if you focus on the most recent price action from the last week, you will notice it made a very powerful breakout. This move clearly shows us that buyers are fully in control of this coin. It also wiped out the bearish imbalance in the market, which means the bears simply couldn't hold it back. Also, make sure to take a note of this previous week's high, because that level is extremely important. Now let's switch over the daily chart and take a deeper look. If you carefully examine the daily chart, you will notice the imbalance zone here. That's the last area where price reacted before making this sharp and powerful move upwards. Just like on the weekly chart, you can see another very strong daily breakout to upside. So at this point, we can confirm that on both the weekly and the daily charts, the market is fully under the bullish control. Now, what I'm going to do next is break things down by observing the 4-hour, 3-hour, 2-hour, and finally the 1-hour charts step by step. Starting with the 4-hour chart here, notice the relative equal highs. This level is not only lining up with the previous week's high, but it also forms a set of relative equal highs, which makes it a clear and attractive target. Next, pay attention to the very large 4-hour imbalance that is combined with a swing failure pattern. That combination makes this chart structure even more interesting. Now moving down to the 3-hour chart, you will see a similar picture here. There's a clean 3-hour imbalance along with a 3-hour swing failure pattern. Then on the 2-hour chart, the same thing shows up again. We got another imbalance paired with a 2-hour SFB. Finally, on the 1-hour chart, you can see it once more. There's an imbalance along with an inner swing failure pattern. This is the exact zone where the price strongly fueled up before making its move upward. And if you look just above, you will also notice another cluster of equal highs forming very clearly. So now we are not only watching the previous week's high, but almost the triple equal highs stacked up on top. That gives us even more reasons to expect the price to continue pushing upwards. Now I have dropped down to the 15-minute chart. Please pay close attention here. We started from the weekly time frame, then moved down to the daily. After that, we carefully look at the hourly charts, including 4, 3, 2, and 1-hour time frames. And now we are finally here on the 15-minute chart. This is what I call a complete and clear top-down analysis. This brings me to a question that I asked very often. If there is no market structure break, or if I do not want to wait for a market structure break, what should I do? Let's talk about that in detail in this chart. Notice right here at our fuel area, there is a bearish imbalance that should have pushed the price down. But instead, it completely failed. On the right side, you can clearly see the bullish imbalance that actually pushed the price upwards. Now the most important part here is where all of this action is happening. It's happening in a very critical and extremely important area. You already know this zone has been filled up by 4 different imbalances. If you look to the left, you will also see 4 separate swing failure patterns confirmed in the same area. So at this point, it is safe to say the bears have been rejected here, and the bulls are launching a full-on attack. This area now becomes a place where we can look for a trade even without waiting for a market structure break. The reason is simple. We have plenty of fuel and multiple confirmations backing it up. But remember, as I always say, your trades need to stay as compact as possible. Don't wait around for the full targets to get hit, like the previous week's highs sitting way above. Get in, take your profit, and get out. Here's the problem. Even when we see a clear target, the challenge is that we never really know where the price will actually get there. Sometimes it can take several hours, and other times it might even take days. The reason behind this is that price often looks for inner liquidity or one last bit of inner fuel or even an inner imbalance before making the final push. Just like in this case. If you look at this chart, you will notice that after hours of consolidation, the price made a small sweep. That sweep was the last move it needed before the big hunt. It was the final piece of fuel required to push the price upward. And that's exactly why it's nearly impossible to predict exact timing of when the price will hit the exact targets. I think only God knows this. This is the reason I personally prefer larger stop losses and more compact trades. Today, let's talk about how we can save ourselves from getting stuck with bad trades in the market. Because saving money is just as important as making money, especially when you are trading. When you look at this chart, you can clearly notice that on the multi-time frame indicator, there is this three very distinctive bullish imbalances right in the middle. There is also this SR flip location that I expected would cause a bounce in the price. So this ended up being my logical trade idea after carefully analyzing and reviewing these high time frame charts. The first clue you want to look for is whether we are forming any kind of swing failure patterns in this area, or if the price is simply crashing straight down. As you can see here, there really isn't much strength showing up at all. The sellers are very strong in this area and keep pushing and crushing the price lower and lower. Because of that, this multi-imbalance level is clearly not holding up the way we would want it to. The next thing you always need to check after that is what is happening on the lower time frames. On the lower time frames, the most important thing to focus on is the structure and the overall trend. If the lower time frame trend keeps breaking downwards and making new lower lows, this is a clear sign of weakness in the price. To take the healthy and higher quality trade, I need to see some real buyer strength step in here. For example, I want to see take out recent highs and continue making higher highs in the area, which would show a developing uptrend and buyer power. Now let's check the same area on the real-time charts using the 5-minute time frame. First of all, let's talk about what we actually have here in front of us. We have this nice inner SR flip location, as you can clearly on the chart, and top of that we also have these open liquidity areas sitting above us for our clear targets. So naturally, my normal expectation here would be price moving up from this area, because we have strong signs and very tradable zone showed up here. But now let's slow down and talk about the inner trend on this chart, specifically the 5-minute trend. If you look over the left side, you can see we were in a clean uptrend, pushing higher and making higher highs, and taking out the previous highs step by step. Then that inner trend structure completely shifted and changed into a clear downtrend. You can also look at the smaller inner trends if you want to, which keeps making lower lows and getting crushed over. So, when I look at this 5-minute chart, everything I see is telling me that the uptrend, low time frame uptrend is broken here. Right now the sellers keep pushing and selling without any change in the inner trend structure. And this inner trend is clearly pointing a downtrend movement. If I want to take an A++ solid setup here, I need to see some upside movements first. For example, taking out these previous specific high areas. And if I need to see further confirmation, I need to see making continuous higher highs before taking the trades. This is one of the most important ways to stop losing money and wasting cash in the trading markets. Let's talk about great setup, clean executions, and smart position management. But sometimes, no matter what you do, things just don't work out the way you expect them to do. If you look at this chart, you can clearly see a great trade location right here. It is a multi-imbalance level combined with a strong support and resistance flip location. Now, as you can see, price rejected these levels twice as a resistance. However, later on, this same area was broken very strongly with a lot of momentum. Normally, I would expect the price to find support in this area after the breakout, and then I would expect it to continue pushing higher from there. So, why do we take this kind of trades in the first place? Because we see this pattern forming again and again and again in all asset classes, and we keep repeating the same pattern over and over to build a statistical edge across probably 100 trades. Sometimes it works out perfectly. Sometimes it fails and doesn't follow through. But in the long run, we are simply trying to gain a small advantage over the large number of trades. Now let's drop down to the 5-minute chart and talk more about the entry location. When I look at this chart, what I see is structure shifts happening on the lower time frames. Also, I see this inner triple equal high sitting there as a clear target. So my natural reaction would be this. With this inner trend and structure shift, we could have at least ridden the price move up toward those triple equal highs above. What we are trying to do here is build a tight and clean setup around that idea. And this is the right mindset to have when we are approaching this type of trades. As you can see, we almost reached a 1.5R gain, which means a solid profit on the trade. But the asset simply did not have enough strength or momentum to fully complete the move up to those triple equal highs. What you are seeing here is basically an inner power of 3 or PO3 playing out. You have your target clearly defined and you have your internal structure shift. So altogether, this is just accumulation phase, manipulation phase, and expansion phase of the PO3 model. In this specific example, it did not fully play out, and setup ended up failing. But that does not mean you were right or wrong as a trader. It simply means that this time the setup just didn't work. In your trading journey, no matter what strategy you decided to use, this will keep happening. It doesn't matter if you trade trends, RSI, pure price action, or smart money concepts, or just order blocks. Your strategy will fail time to time and nothing can stop it. You have to be mentally prepared for failing setups because you are going to lose trades. That is just a harsh reality and the nature of trading. Let's take a look at a couple of clean price action moves that happened recently and use them to sharpen our trading skills. If you happen to look at the Solana chart, you probably noticed this very clear previous day low area. But even before that, we had this multi-imbalance zone combined with 2 hour supply order block above, along with a clean support and resistance flip level. So as a typical price action trader, this specific area should have stood out as the most optimal trade location. If I had been looking at this chart a bit earlier, I would have expected this exact type of movement to happen. Then if I noticed the market structure shift followed by a couple of breakout structure moves, this could have been a great opportunity to take a few short trades here. As you can see, identifying tradable areas and looking for entry opportunities really isn't that complicated. It just takes patience and discipline. Most of the time, it simply comes down to waiting for the right moment to act. However, in this case, something unexpected happened in the market. After the internal swing failure pattern, the structure dropped hard and took out the previous day low much earlier than expected. So now let's break that down. Then, right after the swing failure pattern from the 2-hour charts, what formed next was this very clean and perfect equal low setup. Okay, let me remind myself again here what really happened in this situation with you. Normally, I would expect price to keep pushing higher and higher until it reaches the order block area. But this time, that expected move did not happen at all. What actually happened here was a swing failure pattern followed by an internal structure break, which then created this very clean equal lows. What I see here is a PDL, meaning the previous day's low combined with equal lows. and price is very close to taking that level out. So in the end, taking a short trade right after the structure break and a small pullback into this BPR area is not a bad idea at all, because there is a lot of liquidity waiting below for us, including the institutional liquidity sitting right there. So this is telling me that price is trying to move down right now, and we really should not be fighting against the most current direction. However, if you ask me personally, I would still say the most optimal trade location would be these upper areas to take a short from. So if I were to set a limit order here with just maybe a zero point 0.5 R risk, would not be a bad idea either. So if there are two different trade opportunities available, if you see two trades, it is always better to divide your risk into smaller parts and take the multiple entries instead of going on with a one single big position. Today, let's talk about how to read price action step by step and how to figure out the bias and the trade direction. For example, when I look at this chart, what I see is the PDH, the visible target up above. And down below, when I look at this multi-imbalance area, I also see this SR Philip location. When you spot these inner swing failure patterns with big rejection wicks, you can say we have a very tradable area here. So all in all, what is the expectation here? The expectation is simple. From our entry area, we should rally towards our target, the PDH area, the previous day high. As you can see, this is not a complicated analysis at all. It is actually a very simple method to find out bias and a trade direction. Okay, we have taken out the previous day's high, which is great. So now what is the next step? When I look at this chart, I notice these really clean equal highs sitting above. And right here, we've got this inner support and resistance flip area, along with the PDH zone acting as an amplifier. So my expectation here would be a bounce from this PDH area, following the overall trend, and then taking out these equal highs above. Now this zone with multiple imbalances and those inner swing failure patterns looks like a perfect spot to look for entries. So in the end, my expectation is pretty straightforward again, a bounce from the PDH, powered by those multiple imbalances and swing failure patterns aiming to take out the equal highs above. But hey, look at what actually happened here. Our trade failed really badly, and we ended up losing money on this one. It does not mean the trade idea was wrong, it just did not work out this time. We are out there searching for some kind of holy grail pattern that works 100% of the time. Stop wasting your time, it does not exist. If you can win, let's say 6 or 7 out of every 10 trades, also lose 3 or 4, you are doing really great. That already makes you a solid and consistent trader. So at the moment, we've got one winning trade and one losing trade. So what do we do next? Let's look at the price action, see what is telling us. Since the previous day's high didn't really hold and it is broken really badly, it is pretty clear that the price is weak and dropping hard when you look closely. This multi-imbalance area and the BPR zone could actually be an interesting signal to watch. Also, when we start to see these inner swing failure patterns forming, that can often be a bearish sign. On top of that, we've got this nice equal low sitting right below, which makes a very clear target underneath us. So yeah, you lost the last trade but won this one. That's just how trading goes. You win some and you lose some. There's no such a thing always winning, winning, winning. Or there's no such a thing as always losing, losing, losing. It is always a mix of both. That's the true reality of trading. At the end of the day, what we do is not overly complicated. In your trading, the goal is always to look for a clear possible targets and figure out a strong direction to trade toward. So this is the core of finding your bias. We talk about this kind of targets a lot in this channel. But to actually move toward a target, we need certain confirmations to fuel the gas stations, which is likely liquidity sweeps, imbalance taps, or maybe SR flip areas. And one of the most important thing is always to check is the lower time frames. Are we trending in the lower time frames? Are we making higher highs and higher lows that line up towards our main target? This is really crucial stuff to pay attention to. Like I said, it is not overly complicated. Once you get used to reading price action, it all starts to make sense and flow naturally. We are going through some very interesting days right now, with prices moving up and down again and again. During this time, I received a question about IFVGs, which are basically known as inversion fair value gaps or inversion imbalances. So first, let's take a look at the Solana chart on the higher time frames. We have this very clean SR flip location sitting just below the $90 level. As you can see on the chart, price keeps rejecting this area over and over again. But later on, this level finally gets broken extremely fast and very strongly. What happens here is a classic support and resistance flip, where the previous resistance now turns into a support area. And when you combine these concepts with a multi-imbalance locations, you start getting a very strong potential entry location. If you look close to the candles here, you can clearly see that alt high gets broken and creates a masterclass price switch. So if you're a lazy trader, can you build up a setup like this, just 1-to-1 ratio position using only a 2-hour time frame, a single high time frame? Yes, that is definitely possible. It might not give you the huge profits, but this is a solid way to enter a trade for traders who don't want to do extremely deep analysis. But what happens if we drop down to the lower time frames and continue the discussion from there? When you open the lower time frames like the 5-minute or 15-minute charts, you will notice that price is crushing hard into our SR flip location. This clearly shows a strong downtrend forming on the chart. But I want you to focus for a moment on this large fair value gap area, the imbalance right here. The definition and the real job of a fair value gaps and imbalances to push the trends in their current direction. So with this fair value gap and imbalance in place, this trend should normally have continued moving lower and lower. But what actually happens here is something completely different. That fair value gap failed and it eventually turned into an inversion fair value gap. By nature, fair value gaps behave very similar to SR flips in the market. When a fair value gap fails, they can turn into inversion fair value gaps. It works the same way that a resistance can turn into a support. So basically a flip happens. And this is the basic idea behind trading inversion fair value gaps. Now when you look at the setup here, you can see that's a 2-to-1 risk-reward ratio setup. If you compare this to the higher time frame setup we just looked at earlier, that was 1-to-1 ratio. But this time using higher and lower time frames together can often give you a much better probability when you are trading. But the way you trade will always depend on your own availability and how much free time do you have. At the end of the day, how you trade is your choice, and it depends on your lifestyle. Let's take a look at this 5-minute Bitcoin chart and do a bit simple brainstorming together. At first glance, you can clearly see this very obvious support and resistance flip area on the chart. If you look lower on the chart, the market was crashing hard, but then turned around after this market structure break, which triggered a very strong bullish reaction. So naturally, you can see the market kept making new higher highs and repeated break of structures to the upside. Eventually, taking this long trade feels very natural and logical in this situation. That's because the market kept making new break of structures higher and showing clear bullish strength. There's also a clean support and resistance flip here if you noticed. And you can clearly see the imbalance area right at the trade entry zone. But this trade ended up failing in the end. However, a failed trade does not mean the idea itself was wrong at all. This is actually a very solid and great trading idea. And if I saw this setup again, I would take it over and over and over again without hesitation. It really doesn't bother me at all when a setup like this loses once. Later on, you can see that the overall structure started to shift downwards and the bears slowly took the control again. Price kept making new lower lows and continued pushing the market lower with a strong momentum. If you took a logical short position here, that would not be wrong either. The reason is simple, because price was clearly crashing and following a strong bearish momentum. This is exactly how you follow the momentum in the market. It is almost always better to trade with the power and the momentum rather than trying to fight the markets and reverse the move. And sometime later, if you pay close attention, you will notice the structure changed again with the strong move from the bottom all the way to the top. If you look above again, price came back into this support and resistance flip area along with an inner structure change. This time, the trade actually worked perfectly as we planned. So when you compare the first trade and the last trade, you see one loss and one win. But if you really study them closely, you will notice they are basically 100% identical trades and patterns. So what you do as a trader is keep playing the same patterns or strategies again and again without changing your approach. So what is the real meaning of this video and why does it actually matter? It is honestly not overly complicated at all when you break it down step by step. As you can see, we played the exact same patterns in both examples without changing anything. We had a SR flip, followed the bullish momentum in both trades, and waited patiently for an inner structure shift to enter clean and compact trades. Even though we played the exact same patterns, the first trade failed, and the last trade ended up winning. And this is where the real trick of trading of the same pattern actually comes from. It all comes down to timing and the total number of trades you take over time. Because if you keep trading the same patterns, it honestly does not matter what the tool is. It could be RSI trading, it could be trend-based setups, or it could be even moving averages. If you take the same trades over and over and over again, hundreds of times, what we are really trying to achieve here is the net profit at the end. A lot of people focus too much on a single trade instead of a bigger picture. For example, they say, I used this pattern once and the trade failed, so this pattern must be useless. But the truth is, you cannot see the results until you trade the same patterns, setups, or strategies consistently for hundreds of trades. Now let's talk about how to read market structure and get a solid idea of the price action on any chart. Here we are looking at a 5-minute Bitcoin chart that shows two specific liquidity levels as your main targets, the previous day's high and the previous day's low. We also have this nice area of equal low sitting below, which acts as another clear target for the price. When the price gets really close to the previous day's low, or the PDL, you can see that the trend has been pretty bearish overall. and there is a clean support and resistance flip happening around that zone. At this point, the structure is clearly trending down, heading right toward the PDL. We confirmed this. So taking a short trade here wouldn't be a bad idea at all. You get a clear target downside, a bearish structure going on, and a nice SR flip and imbalance area lining up perfectly. Everything looks great on paper. But this is where the reality of trading hits you. This setup actually failed, as you can see, and that's okay. That's how trading works sometimes. A little later, the price broke up really strongly, moving up fast and getting close to the previous day's high or the PDH this time. Now you can clearly see that trend has shifted. The lower time frame is showing higher highs, meaning the momentum has flipped bullish. This is your moment to switch your bias. The short-term trend is now up, making new higher highs and heading straight toward the PDH target this time. Since the structure has shifted upward and is now moving toward the high level, your trade idea should flip too, looking for long setup instead of short ones. You want to take those long trades on a nice pullbacks, ideally around SR flip zones or imbalance areas. As you can see, whether it is a short or long trade, the core idea stays the same. Sometimes it works perfectly, and some other times it just fails. That is the reality of trading, and every trader has to accept this truth. Now let's take a look at the Ethereum chart, which actually has a pretty similar chart to Bitcoin. The trend was quite bearish at one point, constantly making lower lows. So taking a short trade during that time wasn't a bad idea at all. It was actually a pretty solid setup. But then, at some point, the internal structure shifts. The price starts to pushing higher and higher, making new higher highs over and over again, and it begins moving strongly to the upside. Now, at that stage, you need to ask yourself, where is this bullish short-term move heading towards? And the answer is simple. It is heading towards the PDH, which stands for the previous day's high level. Along the way, the price gives small entry opportunities for both bigger positions and quick scalp trades. But the real question is this: how do you trade this? Because every trader has a different lifestyle and trading routines. Now, the first option is for people who are super busy. If you are someone who does not have much time to sit and stare at charts all day long, setting up these bigger, longer term setups will work best for you. The target is clear, and since the lower time frame is showing a bullish trend, you can simply set your trade and use a slightly larger stop loss. Try to aim for around 1.5 or 2 hour maximum on these setups. It is a great approach for busy traders who don't want to constantly watch the screens. And the second option is for more active traders, the ones who can spend maybe 3, 4, 5 hours a day watching the charts. For you, it is better to take smaller scalp trades, which in the same direction as the PDH, always following the low time frame structure and the trend. As you can see, there are different trading styles and approaches that can fit just about every type of trader out there. What you are looking at here is the 5-minute chart. What we are going to do is a bit reverse engineering, starting from the lower time frames and working our way up to the higher time frames. By the end of this, you'll understand how to take trades using only high time frames with confidence. Now, pay close attention to this significant price point. It is really important to notice. Here, the price sweeps through this inner equal of liquidity. This is often called as a liquidity grab, which happens right around an SR flip location. That's where support turns into resistance or the other way around. After that, the market pushes up and rallies straight towards this obvious target, the previous day's high. As you probably know, this setup comes from a low time frame and it is a very classic trading pattern that we often rely on. Now let's move over to the higher time frames, mainly focusing on the hourly charts. Notice the significant multi-imbalance zone, which forms exactly at the same spot where our inner equal low was swept. At the same time, you can clearly see that we have multiple swing failure patterns supporting our trade. So if you zoom in carefully on the higher time frame, that is what you will notice. The earlier low time frame price action we talked about all happened right within this area. Now I've switched over to the 2-hour time frame only just to take another look at the price action. Remember, this is the same asset, same price action, but this time with that eagle vision view comes from using only higher time frames. From our analysis on the lower time frame, we already knew we had a clear target above the previous day's high. And do you remember those equal lows that basically wiped out liquidity? Yeah, this is the exact same spot. But now we are seeing it from the perspective of the higher time frames. We also had that big imbalance zone where price came in, swept the liquidity, and tapped right into it. And finally, we have the SR flip zone. Do you remember it from the lower time frame analysis earlier in this video? This is the exact same area. Okay, if I were to trade this chart just based on the 2-hour only, without even checking the lower time frames, what would I actually do? Well, my ideal entry would be right where all the three price action came together. This equal low liquidity sweep area, the imbalance tap, and the SR flip zone. So it would make sense to place a limit order right around that level, right below the equal low level. For my stop loss, I would keep it below the big imbalance area just to give the trade enough breathing room. The reason is we never really know how far the price might pull back. There's no solid data that guarantees an exact reversal point. Finally, as for my target, I would keep it pretty tight, maybe a maximum of 2-hour or even 1.5-hour if I want to stay safe. I wouldn't hold for the full move all the way to the target because price can get really choppy and take a long time to clear that level. We just don't know how long it will take. Remember, we use targets like the previous day's high or previous week's high mainly as a directional bias. We expect the price to move in that direction, but we never really know how long it will take to actually get there. Let's take a look at this 5-minute Solana chart and break down everything we can learn from just a single time frame. We actually have two very interesting price actions showing up here. First, there is the possible target sitting above the PDH, which is the previous day's high, and right below, a clean support and resistance zone, often called as SR flip zone. As simple as that, we can already identify two key things: a possible entry location and also a possible target. Now let's zoom into the area a bit closer. Here we notice a very large imbalance sitting right inside our entry zone. And we can also see the very first signs of a possible market structure break starting to happen. As a normal trader, you would probably recognize this opportunity and decide to take the trade. That's perfectly fine. It is a valid setup and there is nothing wrong with this. This is just a very natural trade with the possibility of a very natural loss. But let's think for a moment. What could we have done differently here, especially because of this extremely large imbalance zone? Well, one option is that our stop loss could have been widened to cover the entire imbalance area. But here is the real question. Does that give us the ultimate solution? Because when you do this, you will quickly notice that your profit potential becomes much more limited. So these choices are not always easy to make, and giving a final decision isn't simple. Now let's imagine you did take that first trade and unfortunately got stopped out. It is not the end of the world. Then a second trade opportunity shows up, this time with a market structure break and imbalance forming inside the zone. At first glance, you can see that this 2-to-1 risk-reward compact setup worked out really well. However, even then, it might still be wise to cover that imbalance area. Sometimes accepting just 1-to-1 profit ratio isn't the worst thing in the world. Even though a 1-to-1 ratio isn't always ideal, the truth is we sometimes need to accept the reality and be content with the profit we managed to secure. Now let's take a look at this 5-minute Bitcoin chart. We can clearly see two important levels here. One is the previous day's high, and the other one is the previous day's low sitting down below. Above the PDH, we actually have almost relative equal highs as well. And above those highs, there is also a very large imbalance area, which you can notice right away. So overall, we already have some strong reasons why the price could move higher. If you pay attention to the very top, you will also notice a bearish support and resistance flip location. And keep this in mind. Support and resistance flips are not only useful for entries, they can also serve as great targets. This whole zone also lines up with the 112K round number level, which makes it even more interesting. Now, let's think about the entry location. Where should you actually get into this trade? What is the most optimal spot for the entry? If you look down below, you will notice a really clean SR flip area. And just above this level, we can see almost equal lows sitting there, ready for a liquidity sweep. After that, the market structure breaks and we also get an imbalance forming. This setup gives you about 2-hour trading opportunity, which is a very classic move you will see again and again. This kind of trade is not bad one at all. In fact, I've seen a lot of students took this exact trade and even posted the results to me on Twitter. Let's talk about how to find the best setups before they actually happen, and how to spot those great price action points where we can take trades confidently. For example, when you look at this chart, what do you think is the best setup? What is the first thing that catches your eye here? For me, when I take a step back and look at this chart overall, I would say a 2-hour setup with a limit order looks like a solid trade idea. This would be the setup I would personally consider taking. But how I really made the decision on this one? The first thing that jumps out at me is this large multi-imbalance area. This kind of imbalances is usually one of the easiest ways to spot potential entries in the market. Then, if you take a look over on the left side of the chart, you will notice a very strong support and resistance flip zone. Price has rejected this level several times in the past, showing that it's a really reactive area. Finally, take a look at this inner liquidity level right here. This is what we call as inducement. Inducement is basically the fuel behind the price before it makes a big move. Now, when you combine these inducement zones with other imbalances and support and resistance flip locations like this one here, that is when you start getting some really clean and high probability trade setups. One of the best point of interest, the POI areas. So the ideal move we would expect here something like this. Price moves down first, sweeps that inner liquidity as inducement, taps onto a large multi-imbalance area along with the support and resistance flips, and then rallies up to take out the previous day's high and even the previous week's high. That is the kind of setup that looks absolutely perfect on paper. A+++ setups. However, what actually happened here a little bit different. Price never put back into our entry zone at all. Instead, it just went straight up and hit the targets without giving us any entry opportunity. Now that brings us to the important part. How do we deal with trades like this one before they happen? First of all, if you look closely, you will notice that the price starts making higher highs inside the structure, which means buyers are still control here. At this point, you got a decision to make. You can split your orders into two parts, using half your risk on this inner breakout and setting up another limit order at your original, the ideal position. Because in my opinion, there's a still good chance the price will pull back into that original trade area. This setup would be a really smart move to use. This is what we call order management. Your second option is to use what we call as ladder orders, risking around 0.3 R on each trade, but going for a bigger reward on every setup. This method is known as a ladder trading in order management. It is another classic way to split your entries, especially if you are not totally confident with your first entry. And lastly, one of the most common order management strategies is creating an average entry price, something I teach in my masterclass as the yo-yo entry style. This is actually one of my favorite techniques for managing trade entries. With this style, you almost never miss any entries. But keep in mind, your profit can be a bit smaller or larger depending on where your average entry ends up. So now, you've just seen 4 different entry models and order management techniques around inducement areas. But here is the question, what do all of them have in common? No matter which order management style you go with, the main rule stays the same. You never risk more than 1% total on single trading management. You can risk less than 1% if you want, maybe a total of 0.5 R. But most of the time, do not go over the 1% limit. How you split your orders really depends on your quality of the trading setup. If you are feeling unsure, a little bit confused with the setup, or not fully confident, just lower your risk and split your order into smaller pieces. Yeah, you might take a little less money as reward, but you will protect your account, and that's what really matters in trading. Let's talk a bit about the recent price action in Bitcoin and Ethereum and go over a few important price methods and concepts. Lately, the market has been pretty bearish mainly because of the growing tension between United States and China. If you look at the charts on a daily basis, you will notice that institutional levels like the previous day lows combined with these perfect equal lows make for some really solid trading targets. Now, I am naturally a long trader. I honestly hate taking shorts. But sometimes you just cannot ignore what the price action is telling you. We are definitely in a bearish moves nowadays. And right around this SR Philip location, there were some amazing trading opportunities for us. Someone recently asked me to talk about order blocks. And honestly, they are pretty simple once you get the hang of them. A bearish order blocks, for example, is basically the last few consecutive green candles in a row that end up causing a big drop or break in the market. In this example, you can actually see a series of 3 order blocks made up of multiple green candles. What is happening here is not all that complicated actually. Since the overall bias has been bearish, those order blocks kept pushing the price downward, and the SR flip areas gives us some really nice entry opportunities. Even though the market's been rough, we can still stick to clear trading methods. First, you want to find a clean target, something like the previous day's low combined with equal lows. Then make sure the overall lower time frame structure is bearish and moving towards your target. So as you can see, we combine couple of things together. I hope these methods make sense to you. If you apply them properly, they can help you improve your trading results. When I was checking the Bitcoin chart, I noticed it had a really similar structure, especially this area with the SR flip and the order block above with an imbalance. That could have been one of the best possible short entries. However, as you can see, price never put back to that entry level. And that's just the reality of trading. You might have the perfect setup, perfect entry points according to your strategy, A+++ setups. But sometimes price just does not pull back at all. So instead, what actually happened here? First of all, price started making these inner breaks, probably aiming toward the PDL. That is the previous day's low level. It used this inner order block combined with the imbalance and also reacted around those inner SR flip zones. So in the end, if you just wait for one perfect setup, you might never take a trade at all. Sometimes you got to adjust your risk and take trades that might not be the perfect, but still make sense within your plan. Trading is rough and it is never going to be easy because these markets are unpredictable and quite challenging. Let's talk about this Bitcoin chart using our favorite ICT multi-time frame indicator. It is pretty clear that we have these large multi-imbalance areas sitting right in this zone. As you know, we found out this area by using the indicator. This area is also lining up with the swing failure pattern on the 1 hour time frame, if you take a closer look. On top of that, this is an overall support and resistance flip area as well. So basically, we got three different things lining up on this chart all at once. Let me break it down quickly with these visuals. We already know Bitcoin has been in an uptrend. It has been rallying pretty strongly over the past several days. Because of that, it created this multi-imbalance zone that we can potentially use to look for trades, plus a swing failure pattern here. Now, this same zone is also overlapping with the SR flip area. Again, we have three solid price action signals coming all together in one single area. That gives us a really nice trade zone where we can start to look for opportunities on the lower time frames. Alright, so that covers the higher time frame analysis. But what about the lower time frame analysis? What exactly should we be watching for down there? Well, it is usually better to look for some kind of structure change on the lower time frames. That way we can confirm a possible reversal using market structure breaks along with break of smaller structures. You can also hunt for those sniper style trades. How do you do that? By watching for an inner liquidity sweep combined with inner SR flip areas and inner imbalance zones. Basically, the same things we are spotting on the higher time frame also show up on the lower time frame. And when that happens, you get what is called fractal sniping. Now, let's get back to the chart and talk about this important area again. As you already know, this is the zone with multiple imbalances, along with a swing failure pattern, which you can clearly see happening both above and below. But like I always say, price action really works best when you have clear targets. So, what do we have here? Well, we got the previous day's high stink right above, just waiting for us. And it is not only that. Right above the previous day's high, we also have the previous week's high line, a price level just sitting there, ready to be taken out. On top of that, you can also spot these equal highs that formed perfectly in this area. So now we have got three different targets lining up together in a single price level: PDH, PWH, and those clear equal highs. Altogether, we have a clear, extremely clear targets here. Now let's drop down into the 5-minute chart on the lower time frame and see exactly how these trades played out. Right in this zone, as you can see, structure shifted sharply with a big imbalance. At that moment, you could have built a nice 2-hour trade setup. That's your very first possible trade idea right here. But if you are not comfortable taking the very first reversal structure shifts, or if the first MSB stops you out a lot, then you will want to wait for the first real break of structure. In this example, that's exactly what happens. It creates what looks like a fractal sniping setup, sitting just above the imbalance area, inner imbalance area. And that right there becomes your fractal sniping entry point. Lastly, you can keep trading the structure breaks all the way until our targets are taken out. Because at this point, we already have a clear target. We have a clear entry zone. And all we need to do is wait for an internal low time frame structure shift that points us toward our targets. Like I've said before, trades work so much better when you got clear targets, a clear entry zone, and when you combine all of that with an inner structure trend that lines up with your direction and your bias. If you follow me on Twitter, you know I kept saying I was expecting a big crash down to around 90 or even 80k over the recent weeks. So even though I am a naturally bullish guy who usually focuses on long trades, there was something pretty obvious going on. The short opportunities were just much better for traders over the past few weeks. For example, in this Bitcoin chart, you can clearly see we've got a couple of multi-imbalance points that line up perfectly for short traders. And they are combined with these clean inner swing failure patterns. So this becomes a really strong area to look for short trades. And on top of that, we've got this clear target sitting below the previous day's low, which basically gives us a nice directional bias. As you can see, it becomes really easy to spot potential trade areas just by using this simple multi-time frame analysis. And when you drop down to the lower time frames besides the previous day's low, there is also this tiny equal low area that can act as another target and gives us some extra directional bias. So right at our multi-imbalance and swing failure pattern area, you can see a clean structure shift downwards on the lower time frames. And you can also spot this very nice 3-minute breaker block area. Well, breaker blocks are basically just a fancy name for support and resistance flip zones. If you look closely, what is happening here, it is really just an SR flip and nothing more. Additionally, price is also coming right into the EQ point of our premium and discount zone. So, how do we actually trade this? Now let's talk about that. Let's take a look at our trade area again. When I was looking at this chart, this 3-minute imbalance zone sitting right above the breaker block felt like the perfect entry zone. But if you take a short trade from the breaker block, which acts like a inner support and resistance flip, is totally fine. This would give you around a 1.5 hour setup, which really isn't that bad at all. But in my opinion, the best entry spot was still this inner imbalance sitting just above the breaker block. That way you could grab a quick 2-hour setup without stressing or overthinking the whole thing so much. However, I know a lot of you struggle with this kind of entries or waiting around in front of the charts for hours maybe. In that case, your best move is building your entries using dollar cost averaging, kind of like a simple masterclass yo-yo system. What you do is pretty straightforward. First, you jump into a trade. Usually, it can be a market order, basically anywhere you want. You don't need to be super precise on your first entry. This is your first order and it gets you into the trade. Now, for your second order, you place a limit order at a key strategic level, which would be that inner imbalance area right above the breaker block and inside the discount zone of the premium to discount range. Now, with this style trading, you never end up missing a trade. And in the worst case scenario, you just create an average entry. Completed the free trading course but still need more? My master classes teach liquidity, imbalance, and the market structure in detail. Combine them with forward and reverse trading using momentum superboxes and yo-yo cost average entry models. After that, you will master scalping with a one-screen free trading view indicator, a revolutionary trading system. Finally, you will learn to invest your profits using my 10-year swing investing with working agent system. Interested? Please see the video description.